Okay, ladies and gentlemen, then let's start with today's session. We will talk about, or we continue what we started yesterday, and we have a little bit more theory today, and I hope we can then switch to strategy. And if it doesn't work today, I promise you will latest talk tomorrow about the strategy, because this is the main part, and you will see the really fantastic approach how you can even see the markets, and not you can even, but how you can see the markets and how you can trade it. I promise you that. So I ask you, be a little bit patient. Just let's go through the theory and that what I've compiled here in this documentation, and then we will come to the strategies. You will see how exciting and how maybe unbelievable even this strategy approach is. So first of all, welcome. We have yes, not everyone aboard so far. Hi Argo, great to have you here. Christoph is here. Ed, Frank, Karen, Chiara, hi, welcome. And Karen is here. Chiara, Levi, yes, great to have you here. Myron, you have a micro as well. Raimo, hey, welcome. RG Robert, hi. Robert, we have two Roberts here. Srini, Tom, Yulas, Eve, welcome. Good morning, good afternoon. Hi, what would we need to set up on Bookmap to follow with the strategy? I will show you that. That's really, maybe you will be speechless when we talk about it. Maybe you will be speechless. That's my goal, to make you speechless, because you will not need much to set up everything we are talking here about, we are discussing here about. And anyway, if you have any issues or whatever, I can help you. Levi is a good friend, and I'm really happy to help him every time. So we are using TeamViewer. Every one of you who wants or needs a help or a hand, I have a TeamViewer license here, so I recommend for everyone download TeamViewer. It's on teamviewer.com. It's a free version. You can run it. You don't need to install it. Then the TeamViewer will give you an ID. That's a number and password, and then I can access your PC. I can set everything up in really whatever it means in a few minutes, even seconds, if it's only the configuration file. Yes, you can download it. It's really easy to do that. So once you have TeamViewer, there's for sure other services as well. But as mentioned, I have the license for the TeamViewer here and for the business, and you can download it for free, and we can simply use it. Okay, that's but yeah, that's not only for seminar members here, it's for everyone who is using TradeFinder and Bookmap. I will help him to set up Bookmap that way, the way it should work and it should be. Okay, great, guys, ladies and gentlemen, let's start with a recap. Let's start with a recap. And please, your microphones, don't be shy. We are here in a separate, closed virtual room. We can talk about everything, so don't be shy, and please, your microphone. It makes my life a little bit easier, because how to say, it's a little bit of stress and pressure on myself, on my shoulder, guiding you through this seminar and proving what I'm saying, what I'm showing here. But anyway, one point. I woke up this night. I couldn't sleep because of you, of course. No, I'm kidding. I'm just kidding. I'm just kidding. Okay, no. I woke up because one question yesterday bothered me a lot. And that was a question. It wasn't a question. I don't know who it was, but I remember we had a discussion with Argo. Excuse me, with Ramo. And the question was, let me go. Can you see my screen, by the way? Do you see my book map? Can you see?
Yes.
Okay. Just, you can hear me, you can see my screen. Okay, great. The question was, let me go back, find this, this price level. Yeah, okay. I think that was this, it was that area, or maybe it even it is. And the question was, how do we know? Let me remember. I think the question was, do we have any signals or signs here which could predict this move down? Or my understanding was and is, do we have signals? Which position, either short or long, should we take here at the, let me say, 84, 85 level? That was the question, and I felt the answer in myself. It was on the tip on my tongue, but I couldn't express it. And I woke up this night and I've got an answer, because you remember, Ramo, we talked about the NQ and the stop run into, I don't know where it was, somewhere here. Oh yeah, it was here. I think that was the situation here at 5:34 p.m. my time. That means it's 11:34 Eastern time. And yes, we had the discussion about stop runs here. It was a sweep so far, I know. And the question was, do we know that this might be a short position here? We don't know for sure that we can't predict, or we can't foreshadow this this down move here. That's impossible, because we talked about yeah. Let's move this the heat map here to the right. So that's the situation. Why we can't know what happens the next. We talked about the sweep into this 83 area, then we talked about liquidity. But I will show you another reason why that was a 100% sell. Let me exaggerate a little bit, but I insist to say that was a 100%. We got from the market, in time, a signal that this was most probably a sell here at this point. So I will keep up the tension here in the room, and the tension amongst you is, and please wait until we come to that. I will remember, and I will show you my arguments besides the liquidity here and besides the stop run here, and that what happens in NQ, why it was more important to watch another signal to understand why that was a short. By the way, if we are short, we understand the signals. Where I will try to show, or I will not try, but I will do show you everything what happens when we are in the market. It's simply not in our hand. We are at the mercy of the market when that happens. We can only control our risk. We can only control our trade. We can only control what we are doing when we are in the market. We don't know that the market dropped down for 82, 14 points, 14, 15 points. We can't predict that. We don't know. We can't foresee the future. It's not possible. Everything we are talking here is hindsight. But we do know there was a sweep, there was liquidity, and I will show you an extremely powerful signal why that was a short here. Okay, that's the point. I just wanted to get rid of it, to put to tell you this idea and to get this idea out of my chest, just to be sure. And you, if I don't believe I will forget, but in case I forget, please remind me that I want to talk about yesterday's signal and this discussion here in the room. Okay, great. What I would like just to discuss with you very briefly is what we discussed yesterday based on liquidity, and I would like you to use your microphones to express what do you see, what might be the probable trade idea for the ES at the moment. We will see a stock, we will see we will have a look at Apple, and because that's not only a future seminar, that's also as well stock seminar. If you trading stocks, either options or direct, I don't know, the principles are the same. So what is the most probable outcome when you see this picture here? That's the ES at the moment.
It a lot of liquidity at 95.
Yes, and what else?
And it's 700, so second layer.
Yes. Given you have historical data, I hope so. I have historical data, and what I'm recording and what the gap. So what I'm recording is used for, is taken from the storage from disk here, on my PC, and if something is missing, it comes from the X feed. You can subscribe to, I think, 24 hours of historical data based by the DX feed. That means if you are missing the data here yesterday, the data will be simply filled or added by the X feed here. If you don't have, if you only have normal data when you start PC or Bookmap, then it starts to record every data string here. So the important part here, what I wanted to say is simply watch this. 95, they cancelled 195 and added 300 to 4700. That's impressive, really. There was one guy, or let me say, yeah, let's talk about one guy. Ladies, excuse me. I mean, we can also talk about cheat. There was a lady, he added 95 and then cancelled that at that time and lifted from 95 to 4700 here, to 4700. And then added again here. You'll see how they are adding 70, 180 plus 100 plus 60. There was an intentional add to 97, but keep in mind this 4700 is in the book, is still in the book. And now the question is, will the market trade against 95 and 4700? What do you think? Any opinions? If liquidity is a magnet, if liquidity is yes, attractive for the market, will the market trade 95, 4700?
Maybe could wait to see confirmation of like a flush to the downside first.
This one?
Yeah.
Yeah. Yeah, the question is, most probably, if this liquidity remains in the book. Now look here, what happens? What happens here? Guys, watch this one here. What happens at 95?
Cancelled.
Yes. It was cancelled. Minus 180. That happened right now when we start the discussion here. But we have two poles. Let me say we have two sides of the market right now. We have the 67, which is as well an institution level at 67. And we have these, yes, we have the added at 67. This institution level, by the way, have been in the book, or I reported them today in half hour. Yes, just let me think, 8:30 Eastern time. That means 1 hour before the open.
I'm sorry. When you speak about institutional levels, is that spot gamma levels or?
No, that's it's my excuse me. I see it right now. I've added
I
them.
mean, you posted into this what was
Discord
it
room?
called? Yeah, Discord room.
Yeah. Yeah, I'm posting them on Twitter, but I don't have simply the time to do that every day. I'm posting them on in the Discord room very regularly. Who was it, Jonas? I think you asked. No, the spot. I have the spot gamma level as well. So I'm following Brent since more than 1 year. I have helped them to get into Bookmap and to set everything up here. So he was introduced by myself to Bookmap the first time, and then he is providing the spot gamma levels for Bookmap and for what else? NinjaTrader, I think, and for other programs as well. For InQ and Russell, I think. What I have here, I have, let me say, some friends which are working for a big institution, and since we as kind of associates or friends, they just copy me every day what they might expect in the market. This institute, what I can say is simply I don't have any influence on these levels here. They are based on options and other market calculations. I don't know, even don't know, and I wouldn't speak if I know what they are doing, and they are extremely reliable. We will come in the strategy section about and we'll talk a little bit about the institutional level. They are there, they are given. You can use them, they are for free. You can watch them, you can disregard them, whatever. So I'm just posting them, I'm just sharing this institutional level, but they are as well based on options as well. Yes, that's true.
How do we configure those columns?
That's quite easy. I can post the cloud notes here. It's a voluntary service from our room at Chuck, which is a room member, is now putting them in the cloud notes. The link is here. You can use it. It's free. And add it simply to your chart if you want. If not, it's up to you. What I have here is the daily levels. I'm just using based on my NinjaTrader. So what was the high? What was the pre-high, pre-low? What was yesterday's close and pivot point and VWAP and so on. That's simply just for information. I'm not trading that, just to keep in mind what happens. So the call and the third column, SG, means spot gamma. That's what spot gamma, what Brent is offering, and for subscription here on the spot gamma level. So that's the point. Okay, but I just wanted to do a recap, ladies and gentlemen. That was my intention. So based on liquidity, you see what happens here. First impression is, as I think it was Julius said, that we have 4,700 and 95. And suddenly when we spoke about that, 95 was killed. Or not killed, but cancelled in this case. And look here, what was the next? What's happening at 85?
Yeah, they added. So I think it's going to go up.
Yeah,
Because
but we have still the 67 in. It's still there, 100. So at the moment, I think the best answer at the moment is we see this huge magnet at 4,700, right? We see this huge magnet at 4,700. And we see that 95 was cancelled. So there's a probability that the market will trade at or into 4,700 or into 4,700. It's possible, but don't be surprised if they drop down and then this 4,700 remains in the book the next days, and they need more, maybe 1 week or 2 weeks to finally trade into 4,700. But that's the first impression when you open the chart. Excuse me. When you open the chart, you see in a blink what is right now. What is the game? What is the game? What's on the chessboard here? what is really on the chessboard. And they cancelled here. They're offering at 85 and they're bidding at 66 or so, or something like that. This area here. And by the way, guys, Levi, if you're around and you're listening, just to answer your question, what is the price alert? We added this price alert simply because adding graphicals and lines and rectangles using Bookmap drawing tools is a little bit, let me say, cumbersome. It's a little bit shaky. So we added the price alert. You can, it's simply an alert function. You say enable, you can put a label at, what was it? 4667, I think. This is the label, and then you just add the price, 4667, and you see here line is added with a label. You can define yourself whatever you want, and when the price hits 67, an alert or notification, if you are using Telegram, will be sent to your Telegram mobile, Telegram either desktop or mobile, and a sound will be played here on your PC or laptop, whatever you have, and alerts you, okay, this level was hit at 67, and then this institution or this label will be crossed and indicates, okay, that level was hit at that point. That's the Levi. That's really easy. Price alert, add a new line, define the label and the price, enable the alert if you want to hear or see the alert, and then that's it. But at the end of the day or next day, they remain on the chart just for control functions. Remove all, and then all lines will be removed or deleted. So you start from scratch here with concerning the lines here. If you have questions, we can discuss it, of course, via TeamViewer again. Okay, great. So that's the first impression we see on the ES, in the ES future. Good. I would like to come back to this situation here. You are starting now. It's 8:30. I think there have been some news. I haven't had the time to watch them. What might this price dynamics plot what is price dynamics plot indicating here? What are these diamonds? This big. I don't know. I don't have a word for them, so I'm sorry for that. Yes, go ahead. What does this big bullets of diamonds here indicate?
Sellers.
Sorry?
The red one indicates seller in control.
That one?
But that's a kind of exhaustion.
Yes, that's right. Exhaustion, exactly. You see these big bullets, then you see, okay, they start to buy again. There are more buyers than sellers. It is a really good opportunity to go long here, although we don't know when aggressors are hitting the market. So if you are long here, yes, you have to manage your trade as well as here. You see that as well for those of you who has an SI indicator, and I'm using this VDelta stop run indicator. It's nearly the same as the SI indicator and indicates a nice stop run. I don't have a flag here because that's pre-market. I have set my settings higher than the pre-market is. You see the pre-market volume was at that point 200. 320 at the moment. 320 here. It was, it was a little bit higher here. So 500 after the announcement. Pre-announcement was extremely low, 115 market volume, and it jumped up along when their yes, announcement was dropped back to 99. But this gives you an extreme nice idea what the market, where the exhaustion might be. Be very cautious to go short here. We're very cautious. The market, of course, can go short, but most of the time you will realize and you will notice that the market will take a break here because there are no more sellers. They need to find more sellers. At that point here, at 8:34 Eastern Time, you see the buyers came back in. That's a valid long position here, 80. Then they started, exhausted a little bit, and then started back. So that was another exhaustion. And the buyers came back in here. Yeah. Here. It was good for 77, 78, maybe 80, not much, but anyway, it shouldn't be a loser here. And then they're starting back to hit the market here. More sellers into the bids. Exhaustion here at that point. But that's always the same game, you know. Watch for, oh yeah, we have the open, therefore everything is relative to the to the previous market. So we see very, very hard open, hard selling first, and then hard buying. Buyers came back here, and that was, I didn't notice that. Where was the, I think it was 80, 81 where the liquidity was, and you see how the market is trading against the liquidity here, even supported by the buyers on this side. So that's the picture we are just seeing here. Very clear. We have 4,700. 95 was cancelled, but is coming back a little bit. We have 85 here. It's adding. And we have, what is this, 80 here. I don't know whether 80, let me add an level here. Was it 80? I'm not sure what it was, so okay. And the market traded straight up into the liquidity. So you have two visualization now on your chart where you don't need to guess. You can even, and that's my favorite, what I'm trying, but most we will talk about that. You even don't need the subchart because everything is here. You see the supportive icebergs here. We'll talk in a few minutes about icebergs, and they are just coming back and hitting. I'm sure you will see on your SI tracker icebergs on ask here, but anyway, it doesn't matter what icebergs you have here. The market is going straight up here. So we will have a hopefully interesting discussion based on icebergs a little bit later. Coming to rest, and then aggressors come back, and they are trying to lure in this the price here or trade the price into 88, 89, and then maybe higher. But what I wanted to say, what we have discussed at the beginning, you are right. The first impression is the market is bullish. The market is bullish. There's nothing on the downside here. There's nothing on the downside. Nothing visible. We have some interesting though. We have at 30. We have liquidity here. Watch here. We have these institutions levels, which are options. We have zero gamma. We have volatility trigger. If you're looking at spot gamma here, and around 30, 35. There is liquidity there, but it's now relatively weak in comparison to the liquidity which we have to the upside. Bullish. It's absolutely bullish. You can't miss that. Even if you don't have any subchart, it's a very clean and concise and precise picture of the market if you're trading ES. So for those of you who are using trading stocks, I would like kindly to ask to comment What is our impression of Apple right now? How would you try? Yeah, go ahead.
It'll go to 182. Sorry,
Apple?
152. Yeah, so the top liquidity.
I
no,
understood
no.
180, 150, 155, you think? Yeah.
No, it's 152.
Okay. Yeah. Okay, got it. Yeah.
I think 155 as there's a POC.
Yeah, that POC is here, but
I mean, if the price goes up, there will be new
I'm not sure.
POC.
Yeah. But the first impression is, guys, we have to watch for long. So if you are trading Apple, that means if you're trading options and you're taking the premium, then you have to buy a call. The question is now where to buy the call. If you are simply trading options or stocks with options, you are out for the premium. You have to buy a call for Apple. So what probably at this double bottom at 49.70, 90, and it gives you back a few cents. So you are not in a losing position. The interesting point though is if you are using Trade Finder, you will see the high volume. You see what it's traded, 20,000 in the markets, on the market side right now. On the average liquidity from the first 10, that's a little bit too short. The 10 means 10 cents in Apple. I would like to increase that to at least 50 cents because a tick in the stock, a tick in the stock is a 1 cent. And let's measure 20 seconds of the price. So we have to find the best settings for an instrumental. So we are measuring the 50 levels, so 50 cent around the best bid offer. And that means we are currently trading 1,200 to 200 on each liquidity side in average, and the market volume is at the moment 50,000, 80,000 is increasing here.
Walter.
Yeah.
Yes, one question in between. But can you go back to the ES at the moment, because that's a situation that I also see a lot, and there you see there's a lot of liquidity above and below. It's pretty much the same. There's a bit more above. And what do you make from situations like this? Where do you look at to estimate where it will go? Because it's in a very tight range, only a few points. Yeah.
In this situation, to be very open, in this situation I'm doing nothing because I don't know what they are doing, what they are claiming. I would like to see, look here, liquidity is coming up. It means it could be a pressure to the upside. It means resistance. And look here, 50 are added at 77. So in this situation like that, I don't know anything. I will show you in few moments what the market is doing or will do, and then I will decide what to do based on the overall market. But at that situation, I'm doing nothing. Either I'm long here, and then I have to trail my stop. That's the one outcome. I would have been long here today because it's everything cries long here, and the market simply drops here. But at the moment when you spoke, Remo, it wasn't clear to me what to do here. So I'm not sure. Either you are long from the beginning on, then you have to manage your stops, or if you're not long and waiting, then wait for a signal. So I have a volume spike here. Maybe you have a stop run on your chart, most probably here in this area. That means that it's a kind of exhaustion. That means they need to find more buyers to lift the offer. And in this case, that can be a sign. It's supported by the price dynamics, and then you see immediately the sellers are in control here at that point. That means if you are
And
going
you
long.
stop alert
So-
by 104.
Okay. Yeah.
Yeah, well, actually, while we're at it, there's a really nice thing to see at the chart that I'm looking at. Let me just share it now. Here we go. This one. Okay. There's this one. I need to see the chat. Let's chat, yeah, here. Okay. If you look at this one, and I'm wondering if you see the same on with your indicators, because you see some really big icebergs just before it's going up big time, and
Yeah.
and it's also being combined with a stop run.
So the iceberg, what that means? What means that? You see the iceberg. You have an iceberg of 253, I suppose here.
No. It's on the subchart. Do you see?
Okay. Understood. Yes, we see the same.
Yeah.
We see the same. We see the same icebergs here. You have the same icebergs here. I can reduce them. To. Let me see. Let me have a look on the hidden orders here. It takes time.
Yes. Because if you look at the chart that I have, it's very clear. You see a very clear stop run. You see a very clear iceberg. Yeah.
Yes, we have the icebergs here. I think them are really nearly the same as you have. And then I see a stop run into here and the next one into 89.
Yeah. Okay.
So here.
Yeah.
The point is, I mean, you can use this chart as you have learned from my colleagues here, but I don't know if this is really a sign of in other question. What do you wanted to do with that? Would you like to go long or short, or what's the indication? Raymond.
Well, in this case, if there is a big buy iceberg, of course, then you want to go with the flow and buy as well. And if they have a sell stop run, well, you on the stop runs you counteract. So if there's a big buy, then you sell, but not immediately. In this case, for example, when you see a red bubble coming up, those are some things that I saw that actually work. So.
Oh yes, the stop run.
Yeah.
Excuse me. The stop run was at. I see that right now. Let me see that. The stop run. The first one was at 5 and at the beginning. Here, at the beginning.
Yeah.
At the beginning. Yeah, here. I don't know. I'm very, very cautious with that. So if you want to trade if this is a stop run, might be, I'm not sure. I don't want to argue with that. It was a look here. If you want to see if this is a stop run, and that's Reimer, what I'm trying to tell everyone who is using the SI tracker, and what you have here is simply aggregated data. It's simply aggregated data. You can use, of course, this information for you, but I will show you another situation where you know that the market is going up and not watching this stop runs. Do you a favor. I think it's best to do you a favor and zoom in and see if this is really a stop run. Zoom in.
Okay.
So. I'm very cautious with it. When you zoom in, or when you look very, very close into this the price development, you see that the stop run should be a little bit different. We will talk about sweeps as stop runs as well. I'm very cautious with that. So if it works for you, then use it, and then that's really great. but I need a little bit more evidence. Let's see what happens here. So we have had a stop run here. No, here, excuse me. Yeah, that's a question. I have a different understanding of stop runs than my colleagues at Bookmap have or has.
So can I understand it correctly? Then the stop run will be like that bid-ask spread will be much wider than it used to be in normal way.
When we talk about stop runs, what are stop runs? Stop runs are algo-driven mechanism which intends to take the stops of retail traders. That means when a stop run happens, the intention of the stop run is to trigger the stops and to accelerate the counter move. When a stop is excuse me, I have to reduce the hidden orders here. When a stop is hit, I don't want to see any smaller icebergs here. When a stop is hit, then it is a fast move. It triggers the stops, and then this acceleration, the energy of triggering stop, is used to accelerate a counter move. I will try to show you that with sweeps or with another picture I have to find. Another picture I have to find, or screenshot I have to find, what I think is the best explanation for stop runs. Give me time to find what I mean, but I don't believe, and that's I don't want to hurt you, Raimo, and I don't want to offend any one of you here, but I don't think the colleagues at Bookmap a little bit of what it means to understand what a stop run is. So I just don't want to, to hurt anyone with that, because if you believe that's a stop run, that's okay. I'm fine with that. No, I'm fine with that. It's okay, but I believe that a stop run, and what I have learned and what you can read in the literature, is that a stop run is an maybe a little bit more stronger move than this volume spike here. It's really a strong move up, a very fast move to catch the stops, and then it accelerates the move to the downside or to the upside. Prove me wrong. If I'm wrong, I'm really happy to learn from you here, but I don't believe that this, what we see on this chart here, if we if we look at this aggregated data, look here how this data are aggregated, and you see a stop run, and then you zoom in. So from my point of view, that's by no means a stop run. That's simply an high volume absorption at bid at 75. That's only, we are talking about 76.25 and 76 even here. We are talking about a quarter. 25 point, yes, we are talking about a quarter here. And when you zoom out, that might seems to be a spike, but it is not a spike. It's simply trading. It's simply, they started at 9:30 Eastern time and then simply traded up. So this aggregation of Bookmap might lead to wrong or to different views of the market. And therefore, Raimo, I'm sorry, but I'm not convinced about what the SI tracker is indicating here. I'm not convinced about that. I wasn't never convinced about that, but it's we are free to do whatever, or to think whatever we want, and therefore I believe that simply the open, they traded extreme high volume here. They traded extreme high volume. The imbalances were to the upside, indicated by this triangle here, and everything was crying bullish, bullish, buy, 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 buy. So into 795, 4700, whatever. It was bullish, and I will prove that. I will prove that in maybe today, but latest tomorrow, and I will show you how you can rely that this is a long trade. You will see that. Maybe you will won't believe it, but I'm sure you will believe that. So we have this volume spike that was maybe as well an stop run on your chart, Rhyme. I'm not sure if that was a stop run as well on your chart. So the question is, if that was a stop run, then you have to sell, from my point of understanding. Yeah, but you see what happens here. We have an iceberg 200 hitting. We have an iceberg 150 on ask. That means according, yeah, we will talk about icebergs a little bit later. Guys, prove me wrong. If you think I'm wrong, I'm totally open. But we did a lot of research about the stop runs and that what the SI tracker is trying to tell us. And I know that I worked with Sergey on the MVP here, what's below here. It's very similar to the stop run mechanism of the SI tracker here, this MVP. Very similar. And I know that we have a little bit different opinions and discussions based on that, but that's okay, that's fine. Just to go forward with my recap. Apple, the first intention was to buy into 51 because the liquidity is there. And then the picture turned a little bit. When you see this absolute liquidity at 150.20 here, then that means this is a resistance. This is a resistance area here. If you are trading stocks. And then to the downside, we have as well good targets at 148.50, 148 even. So today it's really hard, maybe for some of you, if you are long and take this as a double bottom because you see the liquidity is up at 158, you have to go long or to buy a call here. And when you see the liquidity is cancelled, 150 and 60 cents here, then that might be a warning sign to tighten your stops or to take profits here, whatever, because we have two poles here to the downside, 148 and 150.51 here. So it's really not clear what a market or what Apple will do at the moment. We have no good signs or signals of the market. You have synthetical icebergs here. You have synthetic icebergs as well here. So it's not, the picture is not clear. We have more resistance on 150.20 here, and I'm not sure what I would like to do here. If not, and I remember, I'm not sure if Jay is around. He posted a nice tweet that the most hardest point is to wait. If the picture is not clear to you, simply wait. Don't do anything, wait. NQ as well. It's a little bit late for NQ. NQ is a little bit more, yeah, I don't like NQ because you see at this extreme low liquidity here, 910. 910, that's really low, but it was a buy from the beginning on here into 16,000 here. So then we have a lot of buy sweeps, maybe a little bit too much. I have to adjust them. Let me say I have to adjust them. To see if there's something meaningful. I'm played around with some different settings here. Let's see, there's calculating. Yeah, I think we must raise the sweeps for the NQ a little bit higher to 150, 200, and then you got meaningful signals. You see, you start to pick the sweep, the swing highs here. You're starting to pick the swing highs, and that's what we want to see: liquidity and swing highs, which are supported by sweeps and volume spike. That means big volume. Big volume is all the time exhaustion. Big volume is all the time exhaustion, and that means volume spike and sweeps. We will talk about that. Can be only measured by with MBO data. We need big volume here to understand that's a top of a swing. Okay, that's what I wanted to talk as an recap based on yesterday. Yeah, that's what I wanted to talk with you based on yesterday. And as I said, we want to make money here, guys. We want to make money. My intention is to show you how you can make money. And I'm not a friend of a lot of icebergs along a route, along a price up and down move, because you see we have 200 icebergs here, we have 150 here. We have, look here, that's the next topic in the documentation. We have had a sweep. Let's have a look at a sweep, right? Real life. So we are just the documentation. We will talk about sweep, stop runs, volume spikes, a little bit about absorption. I don't want to waste your time here because maybe you are not new to this stuff. If so, please interrupt me, and we will talk about that. Yeah, Chris, I will come to that in the strategy section. Please be a little bit more patient on that. Look here, when you see a sweep, and a sweep is different from a volume spike, is that a sweep is an algo-driven mechanism. And when you drill in or zoom in into Bookmap, you will see this picture. That's not a bug of Bookmap. It is simply the incoming data. The data comes in so fast that these are milliseconds, simply milliseconds. And what can we conduct out of the sweeps? And by the way, Bookmap is going to add another indicator which measures the sweep. I think they are copying us. I'm really open with that. They are copying us because what they thought are their sweeps, it's maybe not the right approach, so they will add the sweeps to Bookmap as well. And you will see when you zoom in, the sweep started at 90.92 and ended at 46.90. This is a single order ID. Therefore, we don't see sweeps. We don't see sweeps in Apple or in DX feed, for example. It doesn't matter what you use. We don't see sweeps in, oh sure, yeah, that's not good. We don't see sweeps in DX feed or non-MBO data. Therefore, we called the volume spikes, because we can use them in DX feed instruments. We call them volume spikes, because these are volume spikes. I would show you the mechanism behind, because it takes time, and it takes time to trade a certain volume. You know, in Apple we are talking about 70, 90, 100,000 of market shares who are exchanged within 20 seconds in average. We are talking about average amount, average number of shares. So in ES, we have a little bit different world, because this is MBO data, and we can measure based on the order ID sweeps, and we can differentiate and make a difference between sweeps and volume spikes. We can also, if you want, you can tell sweeps are stop runs. I don't mind. We're just trying to find the best terminology for what the market is offering us. So when you zoom in into Bookmap, you see the sweep started somewhere here and goes down. The last order ID, or the order ID, was finished at 46.90. That means this guy or this algorithm which traded the sweep, the algorithm or this guy, his intention was to get 3,000 contracts. So the algorithm is going to the book and seeing what is in the book. How good are the quotes? Do they give me, or can I get 3,000 contracts? And then the algo starts and it goes down in milliseconds. We are talking about milliseconds really here. You see, it's a little bit off. The presentation in Bookmap is a little bit off, but we can learn a lot of this. Because the sweep started at 92. It stopped or what executed at 90. That means 2 points. They needed 2 points to trade a sweep based on the order ID. And he got 1,206 contracts. A means actively, and passively remained 1,794 contracts. And these 1,794 contracts has been traded passively in the book. So that means he got only 1,206, and the remaining he didn't get 1,794, and this 1,794 have been traded passively in the book.
Sorry, Walter. It means that, if I understand correctly, I mean, the A stands for these were the market orders. With the market orders, they gain all the contracts, and P means that with the limit orders,
yes.
They gain the...
Yes.
Oh, okay.
Yes.
I see.
Yes. We see a buy absorption of 1,518. It's not the best example, but let's look at this example here. Let's look at this example in your documentation. Page 49. It's a little bit better. It's a single order ID, as I mentioned before. It's the same one. So if you take, you will see as well a volume spike, but the volume spike has not the same number, because the volume spike in our trading philosophy, it is based on time. So I'm measuring here the time, or I'm giving the volume spike the time to transact 600 or more contracts. And my time is 1 second here. You can put it to 0.1 or 0.5 and see what happens on your chart, or what happens for this specific instrument. So a volume spike is always measured by time, because we need this time. When we are, I don't know whether I have a good example right now live. Let me see that. No, I don't have a good example. Oh yes, here. Maybe here, this one. A volume spike is, we need the time, because to transact 30,000 contracts, it lasts several seconds. To transact 30,000, 50 or 100,000 contracts. Therefore, we distinguish between, sweeps. Sweeps are order IDs defined by the single order ID, which is needed, and they can only be displayed in MBO data feed, and the non-MBO data feed, like here Apple. Let me see here this number here. Here, that's a volume spike at the beginning. 580,000 contracts have been traded at 150 at the beginning. That means that needs time. Within 1 second, it was a really strong volume spike here in Apple at the beginning, and that's the the difference we are how we differentiate between sweeps, stop runs, if you want, and volume spikes. And as you, Argus, mentioned here, when we look at the ES.
So Walter, that 580,000 is not one order ID.
No. We can't. We don't.
can't do that. Okay.
Yes. There's a difference. If you see sweeps, then you are seeing. You will see sweeps only with MBO data. That means rhythmic or Denali. I think the Denali is the same one, but we haven't tested that yet. And for Bookmap, of course. And if you don't see sweeps in an instrument like stock, like Apple or whatever stock you are trading, or ETFs, then you will see volume spikes. And volume spikes, as I will explain a little bit in a few minutes, are a little bit different because we don't have MBO data. We don't see a sweep. We need the time and the volume transacted. That makes therefore we call it volume spike here. Coming back to the documentation, just to make clear what I'm talking about. What are sweeps? Detectable only with MBO data feed, big aggressive market orders, trading through one or more price levels. So they leave a vacuum behind. So what you see here in my chart on the documentation or live when you zoom in, you see a black area here. So this is simply the timing of the incoming data, what you see these red bullets, because normally they should be along this green line here. But it's not, simply that's the synchronization of the incoming data. And you see a black area here. So that means it takes time. It takes time simply to for the book. The book is empty in that moment, and it takes a little bit time. Look here, the liquidity comes in back in. So even don't know if it's measurable. 53 in 1/10th in 1/10 of seconds here. So that in this case the book is empty. There's nothing because they consumed everything in the book here. And Chris, we will talk about the possibilities and probabilities taking counters to counter the sweeps. The difficulty we have, excuse me.
So Walter, going back, can you make that thing again? That the black thingy. Okay. So basically, it consumed 1,000. So they placed an order for 3,000. Mm-hmm. And they were able to get only 1,206, mm-hmm. and that black area pretty much that much, mm-hmm. right? Mm-hmm. 1,206, mm-hmm. and still that 1,700 is it has to go through the regular book.
Mm-hmm. In this case, yes. In this case, yes. On the other side, when you watch when you see the documentation, you will see an iceberg of exactly the same size as 854. In this case, you will see we have different behaviors based on the sweeps. So he wants to get 3,000. And I'm just my documentation page 49 right now, as you see on my screen, hopefully. And he actively got 2,146 contracts. He traded through 16 ticks. R mean price. Price is 16 ticks. In this case here, live case, means R price 9 ticks. That means 2 1/4. So he traded 2 1/4 and ended at 46.90 in this case. And he got 2,146 and he didn't get 854 contracts. That means in order to close his trade, he need to buy back 854 contracts, either by an iceberg or like here in the book, based on the passive order or the limit orders here, as I think it was Argo who mentioned that. There are different techniques to work and to see what's happening, and what sweeps really are. So they are basically algo-driven, fast, extremely fast moves. You will be surprised every time when the sweep happens, because we can't predict sweeps. They are leaving a vacuum behind. You see this black area. They are trading a certain amount of contracts. We can differentiate between active and passive and the price traded. And if sometimes you will see 3,000 and he will get 3,000. But if this trader here, don't get 3,000 in a row, then he must buy back the remaining rest, in this case 1,794, and it can do that by icebergs, or he can do that because there have been 1,794 in the book on the limit side to accomplish or to finish his order here.
Well, I'm kind of losing on buying back. So he placed a sell order. So how he will buy back that much?
Because there, in this case, in this example, he buys back based on the passive, on the resting liquidity here. You see?
Oh, he will place a buy order then for those? Or is he going to place
No,
a...
look here. What maybe that's a good point here, where my cursor is. When you see exactly what Chris is saying. Look here, 1,300. At that point, at 46.90, they have been passively traded 1,337 contracts at 46.90. You see where my cursor is? You see the dome?
Yes.
Yes. So he bought back what he tried to sell here. That's the meaning of passive. That's the meaning of passive. He actively sold and bought back passive.
Okay.
I mean, why are we talking about that? Because you should understand the difference between volume spikes and sweeps, because sweeps are mostly there. I will, as I promised, to discuss the stop run issue again with you, and what I think, or what we think stop runs are. Oh, there's another one. Let me just see. There's another one. I see that right now here. Oh, that's a nice one here. So this guy, let me say that this guy sold 1,000. What was it? 1,200 and bought back 1,794. And then a few minutes later, 50 and 5 minutes later. Oh no, look here. I'm sorry. I'm really sorry, guys. I missed that. Look here. I'm sorry. I missed that. You see 1,794 and you see these icebergs, 9,794 here. He covered here. As well, that's what I missed here. I thought they covered everything here on this price, but you see the iceberg traded, you see this big bullet in the hidden order plot, and this big bullet here, 1,794 traded here. So you see the match 1,794, and we can trigger we can analyze this icebergs with 1,794. He bought back via iceberg 1,794 contracts. Not sure all the time here when the market went bad, but his order was finished there. Let's have a look at this one. That might be a little bit easier to understand. The sweeps. So, same situation as before. He wanted to sell 1,422. Chiara, just give me a second. Yes, he covered his position completely. Let's have a look at this iceberg. Very fast, went to 6 ticks. He get actively traded 693 contracts and passively 729. The sum is 1,422. And what happened then? He placed an iceberg on ask, which size was 729. And that means his trade is closed. Perfectly traded. He got 693 contracts within 6 ticks. So,
but he still has those 693 shorts.
Yes. What can we learn? What can we conclude out of this behavior? So again, 1,200. He is short. Let me see. He is short 1,206, and he is short 693. So yes, he is short 1,900 contracts. He short 1,900 contracts at this point here.
So one technical question. In BO, if we take a look at those two sweep orders, they probably are with the same IDs also, but with the 5-minute difference.
Yes. No, excuse me. They are different. They have only one. The sweep is included in the data string only with a single order ID, but the IDs are not the same.
So the different order than with the different
Yes.
ID. Okay, but there isn't information about who sold it.
No.
Transactor ID. Okay.
No.
Got it. Mm-hmm.
Chiara, what do I need to install to see the sweeps? It's a part of the Trade Finder, so you don't need, in case you have the Trade Finder, you don't need anything. It's built in the software, so we are not analyzing sweeps based on MBO data. If you check the Market Explorer, you can set the size you want to see. I set my size to 600. That means every sweep which is bigger than 600 or has at least 600 contracts and more will be displayed on chart, because I'm just interested in the big ones. What I want to tell you is I want to see. First of all, I want to make money, and I hope you will make money too after these days with me and with us here. Second, I don't want to see any iceberg, but because from my point of view, it's not meaningful. I don't want to see any volume spike, because I want to see the volumes, the swing highs and the swing lows. That's what's of interest. And as well, this big sweeps here. It gives me an idea that there's a big player who is either positioning themselves short, or he is hedging. But to hedge the amount the market normally needs, we are talking about millions and millions of dollars. I doubt that this is hedging. I don't believe that this is hedging. Simply, I don't believe that. Because when we are talking about options and hedging, we will see that the big hedgers, if the delta of the prices rise for 1%, they must hedge at least 500 millions of shares. So that's really, it depends on the price, it depends on the instrument. I will discuss an example with you. I don't believe that this is a hedge. The most probable idea we developed is that this is a big guy who is really he better informed than we, and he is trying to sell. Even if he is 2,000 contract short here. You can do the math. math is, it's quite easy. When the price drops, let me say 84 or 80, he makes a huge bunch of money here. And because he can't get, he wants to sell 3,000, try to sell 50 contracts in a row. Try to sell 50 contracts in a row. What happens? You get you will first of all, you will maybe try to sell 50 contracts in queue. You will maybe get you will get a worse price. Your enterprise will be the average, and that's what you don't want to have. So the same is in ES E-mini, if I'm talking about ES Mini. Therefore, we need the SPX, or the hedge funds and the institutions are using the SPX to hedge, or Apple and all these high liquidity instruments, not necessarily E-mini. However, the SPX has an influence on the SPY, and the SPY has an influence, or it's a one-to-one correlation to the ES Mini. So if something happens in the SPX, we will see the outcome and the result in the E-mini as well. That's as well valid for the QQQ and the NQ, if you are trading NASDAQ, for example. So therefore, my theory and our theory in our room, based on our developers, Doug and Rick, is that this is not a hedge against rising prices. That might be, and that's really, guys, that's speculation, that might be some big player who is positioning himself to maybe he knows or will see that the prices are going down, and he can sit on this position and let the market go against him. He can sit, and he will sit. And mostly, that's the phenomenon if you are using the Trade Finder. Most of the day, you will see when the session ends, you will see at the end of the day icebergs covering 3,000, covering 2,000, covering 1,500. And that is a good indication that those, or this guy, or this guys here who are selling, in this case, are covering their position maybe at the end of the day, or maybe during the night session or pre-session. He can sit and wait until the price comes back. I doubt that I could do that, because if I'm selling 2,000 contracts, oh yeah, maybe I don't care, because if I'm losing 1-2 millions, then I for sure will have a big pocket to say, okay, that's okay, losing 1-2 millions here with trading or with futures. Any questions to the sweeps here so far? It's fascinating, guys. It's really fascinating, and I will show you what strategy we could build around it. We measured. We did back tests on sweeps. I will just let me tell you what we did. We did. We took the sweeps account. We did a counter trade. And when a sweep happens, we go against the sweep. And we wait until the market comes back and retest. I'm sure that's a divergence here. Maybe, that's a divergence here. See that? That's an exhaustion, exhaustion here. And what you can do, what we tested, is that these sweeps could be traded against. And we, we invented the usage of so-called B-lines. We are testing them. Maybe we will bring up in the next Trade Finder. In the next Trade Finder version, you see how. Come on, what's here? You see how hard it is to draw lines here. So Chris, I just want... Yeah, you know that if this is that's not a stop run, that's simply selling here. He wants to get 3,000, 1,400. You can go against it. The first tests with back tests are showing a result which is below 50%. So this is not a holy grail here, but it's a fair chance to trade against a sweep. Against a sweep. Or if you are not sure to going this way, we will introduce lines. We call it so breakout lines or B lines, where when the sweep started, a line is drawn here on the upside where the sweep started, and to the downside. No, that's not correct here. Sorry, that's not correct. Now, how can I? Okay, come on. That's really bullshit. Rectangle. So the sweep started here and ended at 9T. Ended here. You must be very precise. You must be very precise with that. Let's say 92 to 9T roughly. Oh, no, it's not correct here. Anyway, really annoying here a little bit.
So the sweep, like this box will come up like, I mean, the sell sweep at 4690 will come up like on the immediately, or it will be.
No.
I mean, yeah, it takes time to pop up like this.
No, they come immediately. You won't be able in any way. That's the problem. That's the problem with our backtesting. To go against a sweep, to be very open when a sweep happens, not to be very open, but that's the characteristics of the sweep. When the sweep happens, let me just erase this. It's a little bit really annoying here. When the sweep happens, let's zoom in. When the sweep happens, then the first reaction should be, okay, we should go against the sweep. But this is so fast. And when it trades into 90 and indicates by this flag, by the signal, that's the end of the sweep. You won't be able to take a trade there. It's not possible.
So Walter, the flag throws at the end of the sweep?
Sorry?
The flag is displayed at the end of the...
Yes.
So, but remember at that point he only got 1200. He didn't get full.
Excuse me, again, the flag is drawn at the end of the sweep, yes, and then? Repeat it, please.
But he only got a part of his contracts.
Yes.
Oh, it shows. Yes. And it shows with the active and passive. Okay, yes. It throws with the active and passive. Okay.
Yes. He got only 1200 in this case. And he tried again, few minutes later.
Then he used a different mechanism.
He used the same mechanism.
Same mechanism.
He placed an order for 1,422 contracts, swept through the book for 6 ticks, got 693, and that's all what he got in a row here and here. That means let's say that's the same institution, same guy. Now he is short 1,900 contract. He is now short 1,900 ES future contracts, ESE mini future contracts. So to be very precise, the question was raised by Chris, I think. How should we treat and trade sweeps? And my answer is that we are backtesting, or we backtested sweeps, and the backtesting showed that the sweeps, the successful trading against the sweeps is below 50%. Especially when you are trading manually. First of all, I'm not sure who it was. I think Argo. It was Argo, who's mentioned this is so fast. First of all, you can't predict sweeps. This you can't see behind the algos. They are happening very fast. And then the market comes to a break, and when you realize that this is a sweep, oh, that was a sweep, I have to go against it, the market is far away here. You won't get 46.90 here as well. You won't get this number. By the way, just in this case, when we are talking about this, you see the sweep ended at 46.90 and the sweep ended at 46.90 here as well. That's fishing for contracts because he wants to go short or to be short. We will see what happens at the end of the day. He might be as well wrong, so that's not a guarantee that the market will drop fast, drop lower or trade lower very fast. That's not the story behind. That's not the story behind. But you can read what market intentions are. You see how he is covering the passively 1,794 and closing this order, and you see how he is covering passively 729, covering here, or MASS closing his order here at 46.90. The strategy for sweeps, the best strategy for sweeps, I think is, and we are discussing that, and as I mentioned, we will bring it up in the next releases, is to draw a line where the sweep starts and when the sweep ends at 46.90. It's not a line, it's a rectangle, it doesn't matter. But you hopefully have the idea what's this good for. So to mark a sweep start and a sweep end and looking for a breakout could be a strategy. Excuse me, that's really could be a strategy. We will talk about the strategies, but where I will show you for sure better ones. But you should be alerted that this is something meaningful in the market. This is really something meaningful in the market. Anything else is playing around and maybe speculating what's happening and what happens here. Let's see what happens. Well, where's the market right now? Oh, the market dropped to 85. Interesting. So he sold 90 to 1,900 contracts. Market traded at 994.95. Retested here, and then traded into the next liquidity 85. Still interesting, we have liquidity 700, 4700 and 4702, where this institution level was 1 hour before the open. Let me check that. One. So that's the picture we have today of this market. It's impressively, ladies and gentlemen, when you what I would have theoretically done on NQ, because I'm not trading NQ, I would split the screens. No. Let me see if I can do this here on my Windows. Yes, I would have split the screens and see that someone is selling here. The sweep here is extremely interesting. Supported by an iceberg. I would have bought this one. It comes together with, I would always look in parallel. What happens in ES? I don't know because I'm really unsure. So if I would for sure looking NQ in ES in parallel and see what happens on the NQ and ES. And by the way, when you're talking about NQ, I would strongly recommend to watch the the QQQ as well. It gives you so many information. We will talk about the SPY and the SPX in hopefully today to understand what's really how this stuff is really working here. When you're trading NQ, watch the QQQ, watch the ES, and then you will have an idea what the NQ is doing. Is it better to use QQQ chart for trade? Yes, it is. It is better to start day trading with SES and afterwards to do this with NQ. I would prefer the ES. If you are watching NQ, I suggest using QQQ. I suggest using FQQQ, and I think it's called NQQQ as well. Let's talk in the strategies. I would like to be a little bit more patient. I will come back when we talk about the strategies and about this correlated markets. You see how well the Trade Finder works as well here. You have the liquidity here. So I would watch, and I'm watching for the the SPY, the SPX and others we will talk about, and then I'm making my decision based on what what I see in Q. Okay, now we have the information that this is a big guy who is positioned short. We see that. Very nice with the sweeps, what is traded actively and passively, how he covered using the icebergs, which are matching this passive orders perfectly. The market goes against him. The market went against him, and he is still waiting to cover. He's still waiting to cover. Not sure what happens next, but he is still waiting, or he is still in the book because we don't see any covering of 3,000, or in this case 2,900 contracts. Okay, that's what we talked about. Sweep tracking big players. Big aggressive market orders. The Market Explorer analyzes all sweeps based on market by order data. Market by order data. You won't see sweeps for Cedro. You won't see sweeps for Kinetic. You won't see sweeps for CQG, IQ Feed. Whatever you use, you won't see sweeps for that. We do identify big players by tracking the active traded volume, passive traded volume, and the price which has been traded. So we discussed that. That's a part of the Market Explorer. I think Chiara asked that. It's a part of trading of Market Explorer. You can set, and you must set the volume based on the volume of the traded market volume. So all settings of Trade Finder are based on the instrument's volume, and you know the S has a different volume than the NQ or TF, Russell, or gold, or soybeans, or treasuries. Keep that in mind. Yeah, you can trade again the stop runs. So that's the discussion here between Raymo and myself. Let me just find another example for a sweep which might be an stop run. Yes, why this effort? Why do we do that? Because we, in our analysis, we using TradeFinder with a different approach than Bookmap is using his SI tracker. Bookmap is using the SI tracker as a mathematical program, and you might see now and then that sometimes it works, but the question is, we want to make money, and we are here to make money. That's our first intention. I don't care about signals which causes a so-called noise on the chart, because that will distract me and that will distract my inner monkey. We talked about a chimp yesterday, and I will show you a very, very exciting idea how to track the market direction. And when I'm in, I watch what happens on the market. I see the big sweeps. I'm alerted. I see the big volume, the big volume at 4700 ES, for example. And I'm simply focused to manage my trade, to trail my stops. So why this effort? Sweeps aid us to see where big players come into the market. They intend to sell, to buy, or to hedge a future market. We will never know why they buy or sell for sure, but we will recognize their intentions, and we can adjust our trading ideas for the day according to what we see based on their activities. That's the effort. It's not the effort to say you have to go against. We are testing that, by the way, as I mentioned. You should go against or with them. But this information here is so invaluable, so important to every one of us for active traders. When we see that the market went up very fast from 70, 76, 77, 78 into 90, that makes you or brings you 10, 12 points in a row extremely fast. Even if you only take the price dynamics plot here, because it's tested with the ES future. They went through the liquidity here at 80 like through butter, and then traded in 90. That means if you are long 78, 79, 80, or here maybe even, as Raimo mentioned, 76, go long, go long, go long. So you have the luck. So they are retested this 76, and then they are traded into 90. 10 points, 12 points, close UPC, enjoy your life. That's my advice. And if you want to stay around here, then the next level was this liquidity area at 95, and then this is happening. And then you should be a little bit more cautious with your position. We want to make money. We don't want to trail any single small signal on the chart. What is the logic in identifying sweep? If sell spike to the no. Again, Christoph, a sweep is a single order ID. A volume spike, it leads to exhaustion, and that's the volume spike. That's the difference. That's the difference we find based on our research. To transact on each price level, that takes time, right? I'm going back to this example at the beginning. I can annotate something. Let me see that. I can annotate here. To trade volume or to transact volume on each available price level, that takes time. Right? That's the price here, 67.78 into 78.50. It takes simply time Um, it takes simply time. No, how can I'm not really comfortable with this. It doesn't matter. So this is the price axis and this is the time axis here. Okay. It takes time, and that leads either to a volume spike, which you are measuring. So we need for 1 second, if the price and if we are trading 1,000 contracts in 1 second, that might be meaningful. It depends on the instrument. If we are trading 100 or 200 contracts in NQ within 1 second, that is meaningful for the NQ. If we are trading 1,000 contracts within 1 second in ES, that's meaningful as well. So every transaction takes time because the matching engine, and that's the point why we talked about the auction at the beginning, the matching engine must match every single order. I mean, it's electronically and it goes extremely fast, but it doesn't matter if it goes fast from our perception. It takes time. It simply takes time to transact. And clear our drawings. Okay. Coming back to volume spike. The volume spike takes time to transact, let me say 1,000 contracts in 0.5, 0.1 or 1 second. That's the difference between sweep. We don't have any controls over sweep. They happens because this algo-driven mechanism. We are simply not in charge of anything. We simply can identify them. We simply can identify them on chart. Here, we don't have any influence on them. They're simply happening. We can measure if there's, as I'm doing here for ES, or you can do that for NQ. I'm using 600. I want to see 600. Let me see what I have defined for NQ. 150. So I want to see contract size of 150 in NQ within at least 10 price tick or 10 ticks traded in NQ, and I want to see this 150, and then everything what is bigger than 150, 160 comes up in the chart and it signalizes that is a sweep. That is a single order ID which transacted with 168 contracts here, which transacted with 400 contracts here, and that's the far better number than only 100, 150. We want to see this sweet spots. We don't want to see anything in between. We want to see the swing highs and the swing lows. So, and that's the idea of volume spikes, because we have the measures of volume spikes are volume, the time, volume, the time, the price range, depends on instrument size. Either it's a stock, then you should define 20, 30 cents or 50 cents even. So if you want to see the big ones. And the ratio is simply, we found out is the ratio, if they trade up, then immediately they should be an counter move. So if they trade up, for example, in this example, if the volume is trading up, when the accumulation of the tip, happens, when the last volume is traded, we want to see a counter move, and we are setting the volume traded up divided by the volume traded in the counter move here. That's the ratio. We have had a lot of discussions. I don't want to raise discussions based on the ratio. If you are not happy with the ratio, set it to 2, but you can even filter volume spikes by raising the ratio to 5 or 10. It depends really on the instrument. If you don't obey the ratio, set it to 1 if you are using TradeFinder, and you will get every volume spike based on volume, time, and the price range traded. That's the main difference between volume spike and sweep. Any questions?
Walter, one question. Here pretty much sweep is, we do a counter move. Can you tell me why we expect a counter move from the
Yes.
market or liquidity standpoint? Why do you think that there is a counter move is so high probable?
Yeah,
It's not happen every time, but why it's high probable?
Let me explain that. Because this move, it's not a perfect one, but anyway, it is because this move with its high volume traded leads to an exhaustion. That's the reason. We talked about Monday about the auction, and look here, this is the accumulation of volume here at 89.50. This is the accumulation at 89.50. You see this green bullets here on ask. When big volume or high volume, when high volume is traded in very fast, that means, let me show you that again here. I hope that works. So we have different price moves. There's the price axis and that's the time axis. Okay? The first move is grinding up. So grinding up, the price is going up and price is going up. It takes 30 minutes to raise the price for 2 points or whatever, 20 cents, $1. It doesn't matter what you are trading. Then we have a little bit accelerated moves in the market. So that means this move is a little bit faster. It's not really the exciting move, but anyway, when it goes up, it takes minutes and minutes and minutes and minutes. But the price reached by this move is about, let me say, 4 points or 6 points. The next move we have in the markets are a little bit more accelerated. There's a high pressure behind, so they are exciting. You will see market volume rising, and they are pushing the price. They're pushing the contracts. They're buying everything from ask. They're buying everything from ask, and the price goes up. And the last move that's the volume spike. I would like to say is this move. I don't know whether I can. Oh yeah. Let me say that's the volume spike here. That means when something is extremely fast, it goes within milliseconds or maybe 1 second and it trades 1,000 contracts. That is a kind of exhaustion. I think Srini, you ask, yes, right? That's a kind of exhaustion. No, that's exhaustion. And at the tip of this volume spike, the price. Okay, my question now to you is just I want to keep you awake. What is needed given this volume spike happens? What is needed to move the price further up?
More market already.
Sorry?
More market already. You have to consume liquidity. You have to take out the liquidity on the side.
Yes, more market orders. So sorry, I didn't understood that. But
sorry.
Yeah, no, okay. Just make a short breaky. Does everyone understand what we are talking about here? Does everyone understand what we are talking about? My question was, if we see a volume spike here, what is needed to move the price higher? Yes, Chris, it seems, but it's really no. Therefore, we are talking about it because we see a big because we see a big volume traded at the top of a volume spike, or whatever you maybe even stop run. The price can't move immediately up because they need more buyers to lift the offer. They need more buyers. But on the way up here, there are a lot of anyway. There have been a lot of consumed volume, and that means it needs time simply either to find new buyers. If not, then the market will come back here. So every market move has its own acceleration factor, and what we want to see is the swing highs and the swing tops, the tip of the swings, where the price exhaustion happens. And when the price exhaustion happens, then be sure that the price needs time, or the market needs time to find either new buyers or either new sellers, depends on where the price is, to continue. Or if they are not able to find new buyers, and mostly you will see such a behavior, and the price will drop down because there is a total exhaustion in this area where the price happened. No, not a vacuum. It's not a vacuum. We are talking about vacuum. We are talking vacuum. When we are talking about vacuum, we are talking about sweeps. Sweeps leaves a vacuum because they are consuming 1,000, 2,000 contracts in a few milliseconds. Okay? Not a volume spike simply exhausts because volume is traded up to there, and there are no more willing buyers in this case, in this example, in this drawing on the chart here, who are willing to buy, or who are able to buy, or who are able to consume everything on the ask here. Everything on the ask. Therefore, you understand that a DOM is an extremely important information when it comes to such, to these areas, to these extremes on the chart. We decided to measure the volume spikes or stop runs and to measure sweeps, because both of them has one characteristics. They indicates exhaustion at a low or at a high. It doesn't depend where they happen. Okay. Let's see. No. You see what I talked about? If you put price here and time axis here, then that was a clear accelerated up move. This accelerated up move needed time to recover, let me say it this way. I don't know another word right now, but this very fast up move exhausts somewhere here. Then they are doing the second leg. Then these guys are coming up and selling. And what I wanted to show is, let me see if that works. No, that doesn't work here. It's going now if you imagine here the time price axis here, it's simply going sideways here. So you will see that every single day we have a very fast move this is the first leg. Maybe if you are with Elliott waves, that might be wave 3, then the reaction of the wave 4 here, and then you have the wave 5 here into the liquidity up. That could be another explanation for that. And and that was the question. To answer your question, Srini, you asked, volume spike indicates as well as the price dynamics exhaustion. And where exhaustion happens in the market needs time either to find new buyers or sellers or whatever. And therefore, we just wanted to see these volume spikes where the volume spikes are really of importance to us. How to set up. I will jump up. Absorption. I don't want to talk about absorption very long here. So absorption happens all the time when liquidity, so market order meets collides with limit orders. I'm talking that this way because absorption happens all the time when, let me see that, when market order hits limit order. When market order meet or collide with limit order, absorption happens. You can measure every kind of absorption all the time on the chart here. Let me just adjust this a little bit here. Every time when oh no, I don't like this flags here. Let's me. A symbol is okay. I don't need anything else. Every time when market order meet liquidity, absorption happens. And you can drill down this absorption to 150, 100, whatever you want. You will have a bunch of signals on the chart, which I would not recommend because it's disturbing, simply disturbing. Simply disturbing. I mean, you can do that if you are interested in absorptions. What's of interest, really of interest, is if you have absorption, which is as well. We are here to find the sweet spots or the sweet trading spots. So the absorption is measured in time and the size. You can set it to 500. I don't. And you will find hopefully really meaningful absorption areas where absorption market volume meets liquidity, and that might be of interest. That might be really of interest to watch what happens here. So you see very coincidentally here 791, although they haven't been traded with the iceberg 70, 129 and so on. Here absorption 1518. This is really an over information here because we have the sweep here. We can read really easily what happens in the sweep here. Good. Volume spikes and absorption. Yeah, Karen, I will come next to this. Volume spikes and absorption are available for all instruments and data feeds. So no MBO data feed required. Therefore, The Trade Finder is not working only with ES, but the Trade Finder is working for Apple, for all stocks, for all other instruments you maybe need or you will have on your chart. Especially we designed Trade Finder for stocks as well, and it makes it really helpful to see in advance the liquidity changes, sweet spots here, like here in Tesla. You look here, that's an excellent example, real life. At Tesla, I'm measuring here extremes volume spikes, which are 50,000 against 25,000 traded. That's extremely helpful information just to see where the exhaustion happens. And you see, when you trade this amount and this number of contracts here, like here as well, then the price or market needs to make a break here. What is the yellow dot? We will come immediately after a short break to this point. Every one of you is silent in this room, and that makes me nervous, guys. That makes me really nervous. Just to finish that, volume spikes for all instruments and data feeds. No MBO data feed required. Volume spikes absorption indicates exhaustion at a current price and volume, or at the tip of the end of the volume spike. A properly customized alert of volume spikes and absorption. You remember, liquidity is different for every single instrument. Keep that in mind. Every instrument has its own characteristics. Gives you a signal of a break, stop, or reversal in the market. That can direct impact your active position if you are in the market, tighten the stop, or taking profits. Just to set a foundation, we want to set a foundation, by the way, based on that, what we can prove, what we can trade with Trade Finder, with Bookmap, and I will show you something which is really exciting, which will show you which direction you should trade and go when the market opens. But before we do that, I just want to spend a few minutes on icebergs. And please be here open. The microphones are open. Join the discussion whenever you want. Ask. There are no issues we should have with our discussion here. Everything is fine as well. If you have a different view on the market, that's okay. Because icebergs are interesting. Just before I come to the iceberg, let's see what happens really here in real time. So at the beginning of today it worked. At the beginning of the session, we said it was, I think, Jonas who mentioned that 4695 or 4700 is the probable trading target for today. So we didn't know that, but the market went up in a really 90-degree move very fast. Market is simply out of any fears here. You will see that maybe on the volatility indexes we will talk about. And then it drops around. There have been a big player who sold 1,900 contracts, traded into the VWAP here at 47.80, 586 here, and then 4700 is history right now. Another nice sweep, by the way, here. Another nice sweep, which let me see that a little bit better. Where someone wants to sell 600, maybe the same one. Who knows? I don't know. Used only 2 ticks and sold 316 into the market at 4700. Interesting. Absolutely, what we witness here and what the chances we see here is absolutely it's absolutely fascinating. It's fascinating to me, and I will share my fascination and my excitement with these tools with you here in this group. I'm happy to be with you again. Let's talk about icebergs. We call them hidden order hidden order because they are hidden orders. They are refreshing order IDs. And I remember one question, I'm not whether it was Srini or anyone else here in the room, that they have some difficulties to understand the icebergs a little bit better. So I'm not sure who it was, but if you have difficulties with the icebergs, then let me know that. We have two kind of icebergs, or we want to call them hidden order, because hidden orders, excuse me, just to make a remark. We have two kind of icebergs, or we have two kind of hidden orders. First of all, native hidden orders, and second, synthetic hidden orders. The synthetic hidden orders are orders which are placed by a third-party software like TT Technologies. So if you are a big player, you will most likely using a third-party software or ISV software, or maybe your own software, to place portions or parts of a big order on the CME in this case. That means the synthetic orders are not traceable like native orders. Native orders, or native hidden orders, or native iceberg orders are orders which we can analyze and we can detect in the order book, because this is a single order ID which is refreshing until he unloads or he get everything he wants to have, or wants what his intention wants to trade. It depends on the intentions. We will never know what intentions the iceberg traders, whoever they are, has, but we can find native icebergs, and we can identify and calculate synthetic icebergs. So by saying that, most exchanges offer traders the ability to send icebergs orders due to demand for it from institutional traders or in general traders who trade large amount of contracts. Large traders are considered more informed and more influential than the average trader. And large traders or players use hidden orders or icebergs to conceal their intent to trade at a certain price level. Their large limit order do not display or is not displayed in the limit order book, and therefore these hidden orders do not skew the auction imbalance. An iceberg order can act as an absorption at a certain price level with lack of liquidity in the limit order book. That means it's relatively easy to understand. I've put here an example. So when an order comes in, when an order, or you and we are a big player, we want to sell 10,000 of contracts. Or in ES, let me say the example for ES, 1,000 contracts. We can't do that we can do that in one order ID. I mean, we can that if we are sweeping, then we can get the number we want to, the market gives us. So like it is the sweep here and the sweeps we discussed. We could use the sweep as a way. But if we want to achieve something, anything else, whatever it is, support or resistance, we will chop this 1,000 contracts maybe into sizes of 10, of 20, whatever, and we will refresh the same order ID. That's the difference. We will refresh the same order ID until every single iceberg was sold or was placed in the market. That's important. The question now arises. The question now arises is what are iceberg orders good for? What are icebergs order good for? We can use them as resistance. We can understand them as support. And then the question rises. The next question rises up is, what is a decent size for an iceberg, which has a certain meaning to us, a certain meaning on the chart? And that's where we, or at least I, have a little bit different opinions about icebergs, because we haven't found, based on our research the last weeks and months, not only we as TTW team, but as well with other guys like Doug and Rick. Doug from Discord, not the Doug from Bookmap. We found that there is no clear evidence about an iceberg order and how an iceberg order could be used or utilized in trading. So my concept, my idea, what I'm trying to tell, and that might be as well, Remo, a controversial discussion, is that hidden orders can be a part, or one part of a trading concept. So far I know, and maybe again, please prove me wrong, there's no proof that icebergs are a reliable trading concept. There's no proof that icebergs are a reliable trading concept. If you think so, then simply the proof is very easy. Use your money, real account, and trade icebergs. So hidden orders expose only one information about a traded market. We implemented in the Trade Finder hidden orders based on Rithmic and market by order data strings. So we can analyze and we can find every single order in the book. This is ES and this is Rithmic, and this is 150 iceberg on the ask. It's not a good one here to show, but here I will expand the view of hidden order here. So at 46.88 and 50, 150 contracts have been traded within 772 seconds. So the last 10 minutes have been traded 150 contracts at 88 and 50. That means there was an order. I'm not sure if there was even this yellow line and yellow bullet. We will come to that in a moment. And that means this was an iceberg on ask, which was 150, and you see as well all icebergs, all native icebergs which appeared on chart. You will see them on the hidden order plot as well. So there is no need to put to display every single iceberg, because it's not, at least I'm saying that you decide for yourself, not helpful, at least to me. So 150 traded in 772 seconds. Or it was in the book for 772 seconds. So that means when they finished here, the iceberg might have started, or might have been starting here at 10 minutes before, at 16:45 my time, and lastly finished at 16:59, 10 minutes later here at that place. That was the last order finished, and the order ID was cancelled. Simply, it was finished out of the book.
Walter, one basic question. They're all on the ask side. Are they all limit orders?
Yes, they are all limit orders. I mean, there are all limit orders. But however, an iceberg could initially be traded market first and then switch to limit orders. That's what we researched and examined as well. I think the best answer is yes, there are limit orders. I don't want to confuse you because that's a little bit more, not a little bit more, but it's quite a strong discussion. If you see an iceberg can start to be a market order and then switch it, then this order will be switched immediately on the limit side as a passive order on the limit side. So in general, say yes, you are right. An iceberg is always a limit order. Yes, it is. Technically speaking, we can and we see iceberg orders which starts with a market order and then immediately switch to an limit order. That's that's really a technical discussion we could have, and we could discuss based on that what really an iceberg is and how to count. Is this 150 or is this 151? Or it's really an ongoing discussion how to see this iceberg orders. But iceberg orders are single order native iceberg orders are single order IDs which are denominated or designated here by this n. You see this minus n, hidden ask minus n means this is a native order which was executed finally at 4688.50. There is nothing left, and the duration of this order until it was finished here at 4688.50 was 772 seconds. That was a native iceberg order in the book. There have been other orders in the book as well, here and here, but I'm filtering. I'm looking for big orders, so we can drill them down to give me a second, it's recalculating the chart. I'm looking for icebergs which are around, bigger than 10, and you will see there are a lot of icebergs around here happened on the ask, on the bid, all native icebergs, and as well you will see the same information here in the hidden order plot. This is simply to prevent that you will get really a scattered chart here full of icebergs along a move, because, and that's the discussion, guys. I personally don't like to see every dot has an iceberg traded. That is most probably the point, but the question is as well, we want to make money in this business, and when we want to make money in this business, we want to understand where to go long, where to go short, what are our targets, and how to manage my trade. We want to make money, and I'm simply not interested to see there's an iceberg on ask which is 12. There's an iceberg on bid which is 26. There was one on 16 on this point. That's simply useless, at least for me. So I'm speaking about myself. Please decide yourself your way to find good settings for your instrument, what matches your trading style. How can we practically use icebergs in day trading with ES and NQ is the question from Myron. Can you show this on the chart? Which indicators are best combined with icebergs? My answer is general. The bigger the iceberg, the more meaningful it can be. But to be very honest, in this whole discussion, let me see the NQ here. This is a native iceberg at 16, whatever, 300. Well, there was another one. So decide yourself. My position is very clear. I don't need necessarily icebergs to make profit in a market. It doesn't matter matter what market it is. I necessarily don't need icebergs. We have done tests, but we just stopped that because it doesn't make sense to say, okay, this is in NQ. We have an iceberg of 90 and NQ at 265. We have to go against it. Show me a good explanation where I could use or go against it. So if I go against it, I'm immediately maybe in trouble here. If I go against it here at 50 in NQ, I might have few points on my side here. If I go against the 100 iceberg, native iceberg at 16,230, I might get few ticks out of this trade, but the market is simply bullish, so it doesn't matter. That could be a kind of hedging. That could be a kind of hedging. I'm a little suspicious about that. To answer your question, just a moment, please. To answer your question on that, I personally agree with people who are saying icebergs has been there for a long time, and we have not found a way to trade them profitably. So to answer your question, Myron, I'm use icebergs, and that might be really controversial to your own experience. I'm using iceberg as an information on my chart, but nothing more. I don't use icebergs as a signal where I would like to put my money on execute on them. So excuse me, Srini, go ahead.
There's one thought process which actually I'm on the same page with you also, but I just want to confirm my thought process on these icebergs. So here, let's go back to, we know the liquidity, we have those, red stripes, and we know the liquidity that we know that's a known liquidity. With the theory that you taught, I understand icebergs it's another form of liquidity which we don't see. So it's kind of basically a one more, if we can assume a one more liquidity line where these icebergs are located. That's it. Because based upon liquidity, we do know, and they are really good signals. They give amazing signals. And if we can replace this, it's another liquidity. That's all I was thinking. That, again, correct me if I'm totally wrong in that thinking. It's just another liquidity provided by these big guys. So
go ahead. So
that's why. So if they are providing liquidity, so basically, if I were you, I would think of another line, like there, right, where you see those pictures, iceberg pictures. That's another liquidity line. If you can draw that, market orders need to consume.
Yeah, I agree with you. So Myron and other ladies and gentlemen here in the room, I'm posting that on YouTube. It is a really controversial discussion about icebergs, and be sure we have had this discussion as well with the Bookmap team here. What now we can analyze them, and we can analyze them, and this is not an how to say secret. Every one of you, if you are able to code them, if you are able to understand the Java language, or if you are doing that for NinjaTrader in C+ or whatever language, you can code icebergs. You can do that. Every single instruction, or the instructions are available on the internet. In the internet, there are theses about icebergs. That's really not a secret. There's nothing secret behind icebergs. And as Srini mentioned, we can use them as liquidity provider. The question now is when the market goes up here. So you see how strong the market is, how the buyings are strong today. We mentioned that at the beginning of today's session here, how strong the market is. Then the question is, what is, I mean, that's more a philosophical question. What is the intention of this 150 iceberg here? What is the intention of him? So he is selling something to market buyer. He wants to get rid of something, or he is providing liquidity. Yes, that could be a good point, Srini. That could be a good point, that this is simply providing liquidity here, providing liquidity there. Where else? We know for sure why this iceberg happened, because he wants to close the sweep with 729. He wants to close the sweep at 17 with 1794. We have a 200 iceberg here. We have an ask, maybe providing liquidity as well. So what is the conclusion out of these icebergs? I'm very clear on that. It's an information on the chart. It's an information about the market, but I don't trade icebergs.
Walter.
Yeah.
Walter. We have one variable in the equation also. There's a market maker.
Yes.
So the market maker, what kind of role it is? It has like a providing also the liquidity, but it's also a hidden liquidity, because he doesn't show himself where he's acting and taking the big players like bets against the other markets, and so maybe it's a market maker.
Yeah, it can be. Yeah, I totally agree. I mean, Argo and other guys and ladies and gentlemen here in the room, we might find a lot of reasons. It's a market maker. It's a big guy because it's 150. He can afford to trade 150. He's providing liquidity into the market. He is covering here sweeps. What else? I don't see any. Let me have a look at NQ. So icebergs here, icebergs there. He is providing liquidity, market maker, sweep, covering 60. The question is, what do we do with this information? How do we make money with this information? That's the main question. And I must admit, and I'm very open. I'm very open with that. I'm outing myself. I'm outing myself here, that I don't simply know. I don't trade icebergs. I take them as an information, hidden orders, and I avoid any philosophical discussion of an iceberg. I see them a lot on Twitter, what they are doing, and this was an iceberg about 30 and 40, and therefore the market must go up. I'm refusing to be part of this discussion, because I don't believe that this is really the reason why the market is going up. And I personally, I'm outing myself that I'm an opponent of, I'm not a friend of icebergs, because they might disclose really what's going, for some of you, might disclose what's really going in the market. The neutral point, the neutral standpoint from myself, where I can live with, is to say icebergs are an information in the market, and that helps me to understand. On some days, by the way, on some days you will see 500 icebergs on ask. That might be a kind of hedging. Although hedging happens mostly in the big markets, in the cash markets. I know that it's really cash markets, and you can't sell 500 millions of contracts here into ES. That's not possible. But it can be that a market maker, an institution, are simply hedging their position by selling 500 icebergs here, 500 icebergs here, 500 icebergs there, and you will see this pattern along a bullish market, or along a bullish market. If you see that and understand this is something meaningful, you know, okay, let's say someone is hedging 500 contracts every 2 points, then I have to go long here. That could be, and by the way, that happened as well in the past several times. So, but it must be the context. We should understand the context of the market, what the market is doing. Is it rising or not rising? And then we will understand it better. However, what I wanted to point out, and where we put an effort, where we put a huge effort in our research, is the developing icebergs. I have not the best examples right now. I have them on the chart, but we talked about it. It's quite interesting. It's quite interesting what happens when an iceberg is or develops. It starts somewhere and takes minutes and hours to finish. That's quite interesting to watch this behavior, instead watching, oh, this is 150, this is 2, 16, 20, 30, 40, whatever. So just to show you the synthetic icebergs, and that's simply what we are doing, and therefore TradeFinder works for stocks as well, and simply amazing to see what happens here. Let me have a look here at the SPY. Let's select SPY here. Yeah, you see this is the SPY, and what you see here, this is quite interesting to see that maybe I'm filtering a little bit too low here. You see synthetic icebergs. Let me add this one here. Synthetic icebergs on synthetic icebergs in the SPY. We sell a volume spike. That means in this case we can derive, or we know the volume spike is always a kind of exhaustion. In the SPY we see an exhaustion here. Maybe there was another one. We should, I must measure a little bit more precise, and then that gives me a good signal to go against it, and you see how this traded into liquidity at 470. So you have very similar signals based from 468 into 470. That means 20 point in the S. So one SPY point is 10 point in the S. So that's the SPY with synthetic icebergs supporting them. Just wanted to show you synthetic icebergs on.
Walter, what's the difference between synthetic and native, please?
Synthetic icebergs are calculated mathematically. When we see repeating pattern in the data string for ES or others, here we can as well see them on synthetics. They are calculated as repeating order patterns. We calculate them mathematically. That means synthetic icebergs are not submitted directly on the CME. They are using, for example, TT technologies or other own written or ISV software to place the order. So the big my friends are using synthetic icebergs based on their own software they have written. So if they want to buy 50,000 shares of Apple, they are not submitting maybe 50,000, but they are chopping them into, so slicing them into 5,000 pieces or whatever, and then place them on a single market. It must not be Nasdaq. It can be other dark pools where they are trading those stocks. As well, a synthetic iceberg is an iceberg which comes in as a single order, and it is placed on the CME, but you can't see that this is or this is a part of an iceberg, because it was submitted via a third-party ISV software or whatever to the exchange. We can calculate them only approximately using a pattern detection system, where we can say, okay, that's a synthetic and that could be a synthetic iceberg. But it's not 100% clear and sure like a native iceberg is. We can accumulate a pattern to say, okay, this is 25, this is probably 25,016 iceberg traded at 49.89, for example. But this is calculated mathematically based on pattern. And a native iceberg, like this one here, was placed directly on the CME exchange. Directly on this exchange with a single order ID, and we see the single order ID, and the single order ID is refreshing until he get what he wanted, in this case 150 contracts. That's the difference between synthetic icebergs and native icebergs. Therefore,
just to add, Walter, just to add to that, I think there are a couple of questions on. There is a CME offered this thing to the big guys. They pay heavy fees to CME. They this is like we place limit orders, market orders. We can if you have a ton of money, you can place a iceberg order, but it's like a special order they place. And so that's those are all natives, and those if you want to place a synthetic, you got to go through the other technology.
Yes.
But you can still do it. Yeah. So, and what they're telling is, whatever you place, we don't show it to the outside. That's the benefit they're getting.
Absolutely, yes.
Yeah.
Native icebergs, same order ID. Yes, it is the same order ID. Synthetic icebergs are different order IDs. Yes, that's right. So we again, to place synthetic orders, go back. There's a wonderful page of TT Technologies, and go back and read what they can do with their dome, with their technology. So either you are using TT Technologies to place, you can do it by yourself as well. You are using TT Technologies, and then their dome and their technique will slice your order. It doesn't matter whether you are placing 10 lots or 100 lots. You can say or advise the software to slice the order in several pieces. And then every one of these pieces will be sent to the exchange. And it appears in the book as a normal, let me say, as Srini said or mentioned, as a normal order. So, and that's the difference between I don't want to disclose my intentions to you. That's the point here. And
is that a bit like a dark pool liquidity?
Dark pool is a little bit different because when we are talking about apples, when we are talking about stocks, then there are different exchanges to buy or sell stocks. I think maybe you know that. And we are talking also, we can talk about dark pools. So they are buying and selling stocks on different exchanges worldwide, let me say, like in a dark room. And that will influence, of course, the price of the stock, but that's mainly valid for the stocks, for the stock exchanges here, and not for the normal mini futures and electronically traded futures. That's the point. I know electronically traded futures like E-mini, NQ, ES, the instrument 6E, what else, CL and so on, are, so far I know, not traded in a dark pool. But when you are trading Apple or when you are trading stocks, for example, mostly it will be traded on different exchanges which are connected together to get the best price.
So the X feed won't pick that up then?
Sorry?
The X feed, the X feed, huh? The trading, the signal
Yes.
provider, will not pick that up because he's focusing on one exchange.
Yeah, right. So far I know, yes, the XFIT is not doing that. I'm not sure whether they have the ability to, I don't know. To be honest, I don't know. We have the national best bid offer here for the most instruments. I can't answer that question. So far I know the XFIT is provided from one exchange, but I don't know how they are collecting the data. I can't answer your question right now. Maybe we should pass this answer to the XFeed.
All right, thank you.
You have the possibility to instead to display the best bid, the national best bid offer here for every instrument. For especially, it's interesting for stocks to see the spreads, and that might be that's why I'm really cautious with my answer, because I exactly don't know whether they are collecting the data from different exchanges here and display them here on chart. Not sure.
Okay, well, one more question on the ice. I see that you don't like them as a counter-trend signal. Have you ever considered it as treating them like pivots on a chart? And okay, they can be a place where price is going to retreat from or to continue from. If they are broken.
but we didn't find you. I think I will really consciously leave this discussion open, because we haven't find, and our team and my team and we here as a team, we have two great programmers. Then as well, we are back testing, forward testing based on the Rithmic data, and we found any whatever proof or what's interesting based on iceberg to say, okay, someone is selling 221 here, I have to go short here. I would like to leave this discussion open.
Yeah, that's counter-trend, but
Sorry?
what if that level is broken? That's counter-trend. Okay, someone is selling, okay, I have to go short, but what if that level is then, okay, we retreat a bit, like make a higher low, and then boom, it breaks that iceberg level. Then that's a continuation of a obvious trend then.
Yeah, no? It can be. Yeah, it can be. The point is.
Has that been examined? Has that been examined?
No. I as mentioned, what we are talking. I will show you what we did on the developing icebergs. What we did on developing icebergs of a certain size, certain time, and so on. That could be interesting for us when we see this iceberg developing. But we haven't found. I can't only say we haven't found anything which is really meaningful that we say, okay, we use these icebergs, especially the bigger one, to put a trade on, to get it in the context and say, okay, this 221, which was 29 seconds in the book, he got a fill. He provided liquidity here at 4,700. Therefore, I don't know what to do with that. It's an information. It might be an information based on that, but prove me wrong. Say you have a better system based on that. I will be eager to understand and to learn from you. In this case, what's an icebergs. But I will show you something which is really, really interesting and meaningful and worthwhile to every one of us, because as I mentioned, we are here to make money, and we are here not to look at every bubble and every iceberg and every what we have, anything. We are here to understand the market move, to understand where liquidity is. That's a fact, as we discussed yesterday. And I would like to add this. I would like to add the power of the institution levels. Give me just a second here. I don't know what this is. 04. Where the algos of the institutions might trade around, and these levels where you see here on my chart, you can have them on your chart as well. They are for free. You can use them as a guidance, as a resistance and support levels. So if you have a better idea how to trade the native naked iceberg, let me know. We can discuss, we can prove. We have the optimization, we have the tools, especially on rhythmic data, which we have collected here to run back testing and forward testing to understand how to utilize icebergs in our trading. And by that I'm saying, I just want to close this discussion here, because you see that's that's controversial as well. And therefore what I'm saying, you can adjust the trade finder to find any iceberg, but what is a 16 iceberg or 30 iceberg or whatever of meaning for us? So I don't know. I really admit that I don't know, and therefore we can discuss whatever you want, but we will see there are better indicators which we can use to find the direction of the market and to trade into the direction here. Very easy into the liquidity. You see the institutional icebergs right here, how exact they are. Not every day but I would say 80% of the days, or they are exactly where the price is going to, then remains there, maybe drops back, pulls back, and then trades higher, for example, in this case. Can we sell this? Question. Alexander is asking, can this sell iceberg to be that someone was long before and just covered the position by selling? I don't know. Yves, what do you think? You see the question? I don't know.
Oh, I would say it can be anything.
Yeah.
Taking a new position, or is getting out of a position, or whatever.
So,
Well,
yeah, go on.
Walter, some couple basics things, based on our software only. Can you please cover, the vertical, the profile chart, for the icebergs, as well as the DID line, also the the begin and end of the iceberg, because that's where that was a little bit confusing. You have that yellow line comes up.
That's my next discussion. So if you hear me on YouTube or maybe someone commenting, I'm outing myself to that I'm not a friend of icebergs. I'm not a big fan of icebergs, and I'm not at all a fan of icebergs when I see clustered chart with 10, 20, 30, 40 icebergs. I mean, it's interesting to watch the big icebergs. I just for demonstration purposes, I put them here on 150, but I want to see 100, 300 and higher and bigger icebergs. That's maybe more interesting to watch them. I will discuss the DID in a moment. And we decided, and that was just for your understanding, we decided to put this not to distract the trader, but to put all icebergs in the hidden order plot as well, and the hidden order volume profile. That's here on this side. If you are user or trade finder, we decided just to relax the trader, but putting all the icebergs who are less, in this case, than 150 or whatever icebergs into the dynamic order plot. Every iceberg which is bigger than 150 will be displayed here, but as well will be designated or will be plotted here on chart. So, because as mentioned, you must decide by yourself. It's your decision what you want to have. But we decided to put in plot and as well in the profile. You see on the red side, when you watch the profile, on the red side are icebergs on ask. On the left side are icebergs on bid, and that means when you see a profile like here, like this one, that are simply more, let me say, red bars than green bars, then this is a kind of resistance. You can use this iceberg profile here as a kind of not as a profile. Really, in the real meaning of profile, it is simply a kind of resistance here at this area at 4702. These red bars are accumulated icebergs, and the longer the bar, the more has been traded at those levels here, or these levels, 02. And the longer the bar on the green side, that means that's more of a support. This is a different view of icebergs, and I think for myself, I'm talking about myself just to give you an idea how icebergs could be useful, is when you have such a profile and where you see a big large bar coming up, red bar for example, maybe into a resistance area where liquidity is and where institutional options levels are, and so on, maybe as well spot gamma levels if you are watching spot gamma, then that might be a kind of resistance, and they are taking really breath here and taking a break here, pause at 4702, 47.5. These levels have been long before the market opened, and that might be indication, okay, that's maybe a break. We see 400 liquidity came up at 12.13 with plus 400 added to this level here, which is a little bit higher than the Nexus institution level at 47.10, and this is a kind of guidance where we can work with, but we can't work with smaller iceberg, 10, 20, 30, 40, 50 icebergs along a way, because it's simply distracting. Our inner monkey will jump up and down just to understand what this is, and we want to avoid any distraction from this side. Hi Bridge, how to find out the institution level? Is it based on the liquidity level? No, institution level, I can install it on your or I can give you the link. I thought I gave the link here in the room. I'm not sure. Oh, it's always in the room here. You can add them institutional levels as a cloud notes, but I can help you out, Bridge, after the seminar to set up it on your chart as well. So no worry, this is really an easy task to do so.
Walter, one more question about the price dynamics plot. Since we cannot put in any parameters, can you explain to me how it is plotted? Is it relative to prior activity?
No,
or?
it is based on the dome. It is based on the dome. If this green means here that these are the transactions between the sellers into the bid and the absorption at the bid. So green means this is the activity on the ask. So that means the buyers are lifting the ask, or the buyers are buying everything from ask, and thus they are lifting the offer. The red ones is exactly the opposite what you see here on the chart. The red ones are simply hitting the bid. These are the transactions between sellers and bidders, the red ones, and the green ones are the transactions between buyers and sellers.
And when you get down the darker red, like the extremes?
Yes, you mean that where my cursor is? Yes, this is extreme. This is a kind of exhaustion. That means this band, you can set it if you are using Trade Finder. You can you can set the variable to the size to variable, and I'm just combined both. You can separate them. You see, you can separate the plots. I'm using combined, and I can move the position around. Variable means that the algorithm, the program is counting and put when we drill in, we have to sample. It puts every sample of the trade which happens. I must say it is optimized for ES Future. It doesn't work well with stocks because we have to optimize the sample time and so on. There's a lot of there's research needed. They are sampling the size, and every time when a transaction happens, it is calculated to the already happened sample size or whatever. I can't even express it so well, but at the end, it shows the intensity of buyers or sellers. It shows the intensity of buyers and sellers. So when you see a light green, that means there is no more activity. What you mentioned, when you see this red bullet or this red diamond, you see how they are rising here. That means this volume was bigger than the previous volume here. You see light green.
Then I have a question, because of course if you watching the European session when liquidity is small, let's say that, and then you enter into the American session, and then of course the previous liquidity was small, and then you get immediately a spike up in liquidity, and then you get your red spot there, which is then in fact not very reliable.
This is because as you mentioned, I don't know whether I understood what you mean, is because the liquidity here is thinner than the main session. What you said. I don't know if you have an idea how to change that, or if you have additional idea, write to the support and the developers, because this is the first version of the price dynamics. I'm sure we will do a lot more research on that, but write to the developers. You see how it is. That was the pre-session today here, and then it started to, you see the green here in the European session started to be more greenish. That means the buyers are transacting, buying from ask, lifting the offer. Be very cautious in this area here where you see this big dots, or this big pattern here, and then goes far up and then slows down. That is as well goes with the MVP or whatever you have here. Maybe this the SE tracker, you will see very similar pattern as well here. So be very cautious, because that means always exhaustion.
Okay, thank you.
You're welcome. Okay, guys, that is the discussion on icebergs. So the trade finder analyzes native iceberg, synthetic iceberg, combination of both displayed in the hidden order plot. For better visualization, we have introduced the dynamic hidden order plot, hidden order navigator and tracker, hidden order profile, and dynamic iceberg development. I would like to come to the dynamic iceberg development. Just to show you, and since you maybe might interested, or you have this navigator here, if you are interested to see what happens, if you enable that, there will jump between or toggle between already drawn or happened icebergs on chart. So if we want to talk about this one, that's a dynamic iceberg development. That's a dynamic. So the iceberg started here. I think it was a question by Chiara, not sure. Karen, maybe Karen. Karen, okay, Karen, you that was your question. Okay. With the hidden order tracking navigator, you can toggle between icebergs, just for if you are interested to see what happened. And it might disclose some interesting behavior, because every dynamic iceberg starts with a single order ID somewhere. And by the guys, the Holy Grail, if you want to find the Holy Grail, I give you a tip here. If you know where that this order is going to be an iceberg or native iceberg, or will finally develop in a native iceberg, that's the Holy Grail. Guys, that's the Holy Grail. If we would know that this order ID here, and sometimes you will see at distant points, at distant prices, somewhere here maybe, and then the iceberg develops at 75, for example, and you will see they place the iceberg, they place the order ID at 75, maybe 2 hours ago. And if you want to have the Holy Grail, then if you want to develop it, you are highly welcome to join our team. When we would know that this order ID at that point will develop finally in an iceberg order, then that would be of great help, because then we would know, okay, there's a high informed trader which places an iceberg somewhere here in the book, and he is simply patiently waiting to be traded. That's fascinating to watch these dynamic developments. Let's come back to the dynamic developments. Oh, that's interesting. So if you are interested in third-party software for the synthetic icebergs, yeah, it's off topic. Let's discuss it later, or maybe after the session here. For those concerned with this function gives other participants greater. I mean that's. Please watch this CME group link here. For those concerned, this function gives other participants greater ability to detect presence of icebergs. We recommend evaluating third-party offerings that include ISV-held iceberg orders, so synthetic iceberg where the total quantity is managed off exchange by ISV server. Refreshed quantities from these systems are treated as new orders to the exchange and receive a new order ID. CME Direct will add synthetic iceberg support in the August 2017 release. So I'm not sure. I think it happened, but that was a question. That was a question here in the group. What is the difference between synthetic and native orders? And here's the answer. That all the synthetic icebergs are quantified as new orders to the exchange, and thus they receive a new order ID. That's the difference between synthetic icebergs and native icebergs. And therefore we can detect native synthetic icebergs only with MBO data, but we can't detect native icebergs for stocks, for the DX feed and other feeds. We can only approximately find synthetic icebergs for for stocks and other data feed. That means CQG, IQ feed, and so on. One of the fascinating, what draw our attention is the dynamic iceberg development. We call it DID, D-I-D. It's fascinating because we see in the book where our order starts after the the first iceberg or the first refreshment of the ID or of the order ID happens. Okay? Dynamic iceberg development is analyzed on native iceberg detection algorithm. MBO data feed is required. When a native iceberg is detected, TradeFinder will track the order ID back. The path of an iceberg is plotted live on screen. That gives a unique insight into the iceberg algorithm and intention pressure of how that order wanted to be filled. That leads to a learning effect, how patient algos and their masters behind the algo are, in this case informed trader. This can be, or DIDs can be used to build strategies upon the DIDs. We will talk about the strategy in the strategy section about that, because we did a huge amount of effort in analyzing the DIDs and how can they be of help for us. We found a way, as you can see in the documentation, what a DID might mean to us. This is an example here. I don't see anything of value on my chart right now, but you see this yellow line here, Karen and other colleagues here in the room. This is an indication that this is an iceberg, but the iceberg is not executed immediately. It's not. It started somewhere, and then the price comes into the price level where the iceberg was, or the order ID with intention to be an iceberg or to be executed, sits for in this case 2 hours and 4 minutes, and suddenly the price drops back or comes into this area. It is what, 43.82, again 43.82, again 43.82, again 43.82, again 43.82, again and again, and then the price jumped up. Now, dear colleagues, we can talk and we can see that this is a good support, that it might be a good support. This is the only viable case where what we examined and researched, where we can use the mechanism of a native resting iceberg in the book, based on the size and based on the time. You get when that develops, when it was in the book for a long time, you get following information. First of all, the duration of this iceberg until the last traded part of the iceberg was transacted was 2 hours and 4 minutes in this case. And the amount of volume which was traded on all these touchdowns here and here, 1, 2, 3, 4, 5, 6, 7 big ones, was 1,222 contracts. The slash and the 23 behind the slash means this iceberg is awaiting or wants to trade. The next part of this iceberg will be 23 contracts if the price comes back here into 82. This is a fascinating part of the icebergs, which is more yes, exciting than the iceberg itself. So what we discussed before, when I said I'm not a friend of icebergs and I will leave it to you to make or do with the icebergs whatever you want to do. But this behavior of the icebergs, where we see a development in the book nearly every day, in all MBO instruments, by the way, gives us a chance to speculate and to research more on this behavior. Because if we say it's long in the book and it's trading 1,200 contracts or 800, 900, 1,000 contracts here, then this is a good support. What does it mean for our trading? We should take a position here, a long position, we should take a long position here, and our stop is really clear, determined by maybe maximum 8 or 9 ticks here. That's quite interesting, and when you watch that and when you observe that in your trading, that leads to a probability chance which is higher, a little bit higher than 30%, because there is no guarantee that they are breaking down. It depends on the time and depends on the volume. But when you get the right, when you get this iceberg, when it works, your risk reward ratio is absolutely phenomenal. It's great, it's fantastic. Therefore, it is interesting to watch the DIDs, or this dynamic iceberg development. I have printed the outcome over a long time, over a year, and then over a month, trading the DIDs, although there are several restrictions to do so. I just want to bring the DIDs to your attention, that you should keep in mind that when it works, if it works, you have a fantastic risk-reward ratio. So,
Walter, one question. If I look at this picture, and you see these icebergs is getting filled gradually, and then I watch on the upside, and then I see these yellow lines popping up. Would that mean that this iceberg guy, whoever he is, whatever, big trader, is putting his exit levels there?
Yeah, I don't know. I really don't know. Maybe that was European market here. It can be, if I don't know, but it can be, because it's unusual to see that in the pre-market, in the European session. But I don't know what happened. Yes, let me say before this day. What happened before this day? I don't know. So that means that this could be maybe one of these sweeps here. Let me show you what we talked about. If the theory is right, then the sweep here happens, and he is sitting at 990. We don't see any big trades up to now. Maybe he is 2,000 short, maybe a little bit more. Even here, he is shorting, he is selling, he is selling, he is selling. So the market went against him, and it can be that he is waiting patiently until the market trades into his price level where he wants to cover, and that might be in the overnight session, and it might be the next day. And this, yes, that can be, but I don't know in this case. It's simply. This is a huge opportunity for everyone when you see the pre-market, this behavior with this huge volume and lasting be in the book for 2 hours in this case. This is really a huge opportunity for everyone to take this opportunity long. Because it's green, so you will see. Let me see if I have that's another one here. That's another one which started here. The iceberg, the order ID was placed here, then first hit here at I don't know, 66 or what this price is. Then he is eager to trade this. Iceberg here. You see how they are playing. You see, that's quite interesting to watch this behavior and to learn from these guys. What he wants to achieve here. He's learning. So if you take this long here, you are in a good position. You are extremely 66 trading into. Let me say this is, I don't know, 66 trading into 78, even 78. You are good. You are excellent. You have an excellent risk reward ratio, getting here maybe 5, 10, 6, 7, 8, 9 points out of this trade here. And when he drops the iceberg here, that means he is expecting maybe the price, or he even lifts the iceberg. Every of these signals is real time. It's real time. Okay, I don't have anything more to say to that. Any questions to the DIDs? Let me see if we don't have anyone here today. We don't see anything here today.
Walter, I think we had one like some hours ago from DIT. You're talking about looking for DIT, right?
We have some. Yeah.
That was some hours ago, I guess.
Here, this one.
Yeah.
Yeah, this was smaller one here. So you see. Excuse me. Go ahead.
The theory is, I would be glad to hear about the theory about the DITs. So what's the idea behind the DITs when you programmed it?
What's the idea behind the DITs? Because first of all, we want to track the big one, the iceberg developments. We wanted to track them. We want to see what happens with these icebergs. So sometimes in this case, you should take the theory is go short because there is liquidity. The idea was to track icebergs to see how they behave in the book. We learned a lot about the behavior of icebergs here, a lot, and that means that lead us to the idea that might be an interesting part of a strategy. And it turned out it is an interesting part, and this can be a part of an automatic algorithm which can be developed when the algorithm starts to trade and see the ID which has a certain characteristics. That means it must be a certain size, it must be a certain time, and so on. Based on the back and forward testing, we found out then that could be an interesting trading opportunity. And this is simply because we want to see what happens in the book, and it gives us valuable information about the market, like this one, for example, this picture here, and you will see every day new ideas, new iceberg developments on nearly every market, and that might be a good idea how to trade or what to do with them, to trade them and so on. But it's only, as mentioned, a part of the strategy. It might be a part of the strategy. I added that to the documentation to see what we are doing. It works, but it's not a 100%, or it's not a strategy where you can await every single day a win, or every single day a win out of the strategy. It's not possible. It's simply not possible. That's not possible.
So in that example, this order IDs also remain the same for this guy? Mm-hmm. Okay.
It's always the same order ID. It's simply refreshing. Lazar? Microphone? No, Lazar, you can speak?
Yeah, thank you. On the configuration heading order, we see trigger size is 30%.
Yeah.
What is best time? Is maybe is good 10%?
No, yeah. Let me explain that, Lazar. Levi. Let me explain that. What we did is simply in this case, I want to see I want to see icebergs which are bigger than 150 contracts. Okay. And what I want to see is if a iceberg which happens or starts to develop in the book has a trigger size bigger of as 30%. That means 150 by 30 is 30%, 50. So when an iceberg development starts to develop and his first order is bigger than 50 contracts, is it right? 30? No. The 30% of 150 is 45.
Yeah, 30%.
Okay, sorry, it's 45. So when an iceberg starts to develop and the first traded target, the first traded iceberg is 45 or has trades 45 contracts, then you will see the starting of this yellow line. You will say that this yellow line starts to draw or be drawn or be picked or will be shown on the chart here. So this trigger size depends on the size you have defined here. I mean, you can define even 10 and 10% here, then you will see a lot of yellow dots coming up here. The question as well here is the same. What is important to us? What is important to us, guys? What is really important? And that's the main question. That's simply the main question, what we want to see. And as well, every setting depends on the instrument's volume and liquidity. So my preferred setting is 300 for the yes, because I want only to see the big icebergs. Maybe they will give me little bit more information what will maybe happen on the chart or not. So, and if I set the 300 and 30% here, Levi, that means when the first iceberg starts and it's trading more than 90 contracts, 30% of 300, then this yellow line here, this yellow line will start to develop. It's as always, you know, we can see everything on chart, but I will come back and we are rushing into the option sections, and I will show you something really exciting and we will discuss that. But what I want to achieve with you is, first of all, that you can make money. I will try to say that not every signal is really helpful, and the best way would be to understand that we should focus on what the chart or what the market is giving us or what the market is showing us. As I mentioned, when I'm sure that this is a long position here, then I'm long. I don't care what's on my way here up. I see my target, 4700, or maybe this institution levels, or if you're spot gamma, the combo level here. That's my target. And I'm hoping, because we are all in the mercy of the market when we are in, I'm hoping, and we are hoping, that we have enough luck and the market gives us this return, that it approves that we are right with our assumption here that the market is going to trade into 47 or 100 or 2 or 5 or whatever. That's the main goal. When we see an iceberg developing, or at least that's my opinion on that, I'm watching the 300 and it starts to develop, then I know that the first part, the first chunk or the first piece of this order ID is bigger than 90, and then this yellow line will start to develop here, or will be shown on the chart. Especially when I see in the pre-session, that's a no-brainer, guys, ladies and gentlemen. That's a no-brainer. It's a no-brainer here. That's a gift.
Hey Walter, does this work on other futures markets as well, so that you can diversify?
No, that works only with native with MBO data. When we are talking about native icebergs, again, we are talking about MBO data that works only with market by order data, that works only with rhythmic data. In this case, in our case here, it doesn't work with the X feed and other feeds.
Okay. So all futures covered by rhythmic will have the same success rate. I won't tell that, but they will have the same probabilities.
Yes. Because that's the only way to detect MBO data.
The only trick is then to have to set the settings right and to see what's relevant or what is not. Okay. Right.
Myron is asking what did settings is best for NQ. QQQ, as mentioned, Myron, QQQ is not working, because there are no native icebergs. Let me see QQQ here. We have only synthetic icebergs here, and here. Volume spikes. There are no developing icebergs. For NQ, by the way, I have for NQ.
But if you want to trade QQQ, then you get your IDs from NQ,
Yes,
right?
yes,
In Rhythmic.
yes.
Trade
Yes.
the ID. Yes.
I have the iceberg setting. Excuse me. Signals 50 in NQ and the trigger size is 20. So, but I must admit I'm not trading NQ, so that is the best initial settings for NQ, maybe. But I have to watch the NQ a little bit more closer to find the settings and to see what the best settings are. But Myron, just to mention something what I don't want to. I mentioned in my last video on YouTube is we have added a download configuration file. It's a Cloud Notes. Here, where you find it on TradeFinder info settings, you can simply copy the link of the QQ. Yes, as well QQQ. I will add QQQ as well. For the Nasdaq, for an NQ, you see you can copy this BMCS file. Then it's really simply. You go into your chart settings, load from file, add the copied link into the name here and say open. Takes 1 minute or seconds. Not sure if you can see anything here. Yeah, so all the settings will be added to the NQ I recommend for the instruments. My goal is to give you for the most instrument and stocks the best settings. I think they are the best settings. The starter pack. Let me say it's the starter pack.
For the US for the US session.
It's only for the US session. Yes, it's only for the US session. It's only for. We are considering cloud storage nodes for the pre-session and for the pre-session and for the main session, but it's an awful lot of work to do that. So you can simply switch between pre-session and main session just to have the best, let me say the starter settings. If the liquidity and volume changes and you want to pick this highs, swing highs or swing lows here, you have to do that manually because we can't control the changes of the market volume liquidity then. Okay, any questions so far?
Walter, have you ever seen
where the iceberg, where it initially starts, and I guess when it breaks through the level,
yeah,
then you can reverse it because they have to, get out of their position as well, right? Is that a valid statement?
When they start and they break through the level.
Go back to that. With the icebergs.
Just a moment. This one?
Right, yeah.
So
if they started there
and you yes, that one right there. That was
even
this one right here. So the average is around what? Maybe like around
66.
66. I'm sorry, 68. Right.
So
if it reverses,
and
it breaks their iceberg purchasing, is that a valid point that they have to? Now they're in the red, so now they have to get rid of that whatever they
whatever they accumulated,
The,
and
it has reversed.
and it has reversed and it's going to
no,
reverse the trend.
no, it could be. So far, I understood you. I'm not sure whether I got you what you wanted to know, but it could be. It could be that this. Let me say there where my cursor is. Let me say 60 something, 66, 67, whatever it is. It could be that the price goes up here for 1, 2, 3 points and then breaks through this level 65 or 66. And then you will see simply that there's a finished iceberg at this point here, at 66. So he simply closes the order ID if the price reverses. If not, if it goes straight here and he's waiting for 65, 66, we have two options. Either the price bounces up here or bounces off this 66 level and goes straight up. Either we are on board or not, doesn't matter. Or the price comes back, trades in the 66 and breaks through. Then the iceberg is closed straight at this point. Let me say 66. Yeah, then you will see this iceberg flag. That this is a finished and closed iceberg. This order was closed at that point. Not sure if I answered your question.
Yes, I think yeah.
Yes, I think that I understood that. Yep. Thank you.
Yeah. Great. So, guys, let's do following. I would suggest, and if,
One more question. Can you just back, please, Walter? Walter, how I can know if this yellow one is iceberg from the bid or
here
ask?
you can know because it's green. Otherwise,
okay.
I don't have another example here. I see I don't have another example, but it is an iceberg on bid because it's green. Otherwise, when the yellow line would be here at that point, it would be red. In this case, let me say that's on ask. You know it's a bid, green, and on ask it will be red.
Walter, that's at the end,
Yeah.
right? Not in the beginning.
No. Yeah, this
Continue.
label here. You see the label here. Maybe
But that get
no.
flashed.
This label
once it's
is
closed.
constantly there. If they
Oh, it's there
yeah,
already.
it's constantly
Okay.
on the chart. The label here, it's constantly on the chart. It's constantly it wanders, or how to say, it goes with a progression of the time, So when the first iceberg, or when the first iceberg was traded here at that time where my cursor is, then the time progresses, goes forward, and you will see this label is simply goes with the time. It goes with the time. It's all time there. It's all time there. You will see how money is traded, how long is it in the book, and what size is traded, and what is the next size which this order ID wanted to be traded. That's the simple mechanism. This green label or this red label, depends on, is always there, and it guides you through this labyrinth of icebergs. The information is always on the chart.
And we have I see a imbalance symbol, red and green. How we need to use this symbol? Is exactly sometime working or is not working?
Yeah, that's the issue of the changes in the liquidity. We talked yesterday about order book imbalances. This is the part of the imbalance tracker. And what means imbalance is simply that the imbalance tracker what it means is that the imbalance tracker is
Walter, I understand what is imbalance is between bit and us. It's about dome
Yes,
level,
it is
yeah?
it is the level on the dome in the order book, and the imbalance tracker watches or tracks where is where on which side is the higher imbalance in the book, on the ask side or on the bid side. And therefore, I think there was a green line, green. Oh yeah, I know what this stuff is doing, because I know that. I'm sorry, guys. I reloaded this stuff here, and now every single instrument is going to be reloaded. That's really messy right now, so I'm sorry, I apologize for that. I just added the BMCS file to NQ, and I see that ES is reloading as well. Let me see that. I thought there was an imbalance as well, not sure, but let's have a look at the NQ. I have, what did I have here? ZB? I'm not sure. Strange, guys, strange. This is simply, I'm missing some information. Anyway, it doesn't matter. When this imbalance shows you with an we will see it tomorrow for sure. We will see that tomorrow for sure. But this imbalance is showing us, it's indicating where the higher imbalance is in the book. Maybe this is recalculating everything, so I'm missing a lot of information I see here. Is indicating where the imbalance is, and the theory is that the imbalance is the price is looking for liquidity, and the price looks for imbalance. Look here, we have, for those of you who has the NinjaTrader or similar products, NinjaTrader, Sierra, whatever, this is nothing else but an depth chart or imbalance chart. You see how this imbalance on the bid and ask changes all the time. That's very similar to that. If you have NinjaTrader, I'm sure that's available for Sierra, for every chart available. So this imbalance is there. The indicator is there to show you, okay, dear trader, there is more imbalance to the upside. I mean, we see that visually, but when we get a signal here, maybe a triangle or whatever, we are more focused that this could work, the price could trade into the upside. It's not working for every instrument. It's not working for cryptos. It's not working for. Yes,
it's
yes.
working. Example, if I see a green imbalance, what I need to give?
No. That's Levi. That's not an indicator. It's just an information that the imbalance in the book is to the upside. Don't trade the imbalance. Don't trade it. It's not an signal to trade something. It's an information. It's an information that the imbalance in the book is on the upside. That's all. I'm not suggesting we are not trading imbalances. It's just here to inform you, dear trader, there's more imbalance to the on the upside or on the downside than on the other side. That's everything. And when the imbalance is there, look here for the SPY, it's not useful to have imbalances. That's the MVP here. It's not useful to have imbalances because the liquidity is highly distributed here in the book, so it's not useful. Don't use it as a signal. Don't use it as a signal.
Maybe if I see imbalance and sell sweep and iceberg all together, it's like puzzle. Can I suggest what I do?
Yes, give me another. Give me some time to show.
if I see sometime, okay, I'm see imbalance, and after imbalance coming sweep. It's 2 points. I can to see. Maybe I can to give short or long or
No, when you see imbalance, you will not trade. You do not trade. When you see imbalance, you do not trade. When you see a sweep, we will talk about it. You can counter the sweep. You can go against the sweep. The chances are good, but they are not perfect. If you see, like here, look here. That's a volume spike. Here, that might be a stop run or volume spike. I like the volume spike, but I'm sure this is Ramo and stop run on your chart. And when you see that, I think that's the best way to counter this trade, because this is a kind of exhaustion. You see this big volume, traded 2,436 contracts against 767 contracts here. And what we talked about a little bit before, this is something where you should be very cautious with further long positions until you get other signs. But the market is strong. The market is strong. So it takes simply time to find new buyers. And I suppose they will try to find new buyers based on the institutional levels or this levels or whatever it might be. The next levels are 47.10 and 47.13. Or the next level could as well be, and that would be famous to see that, if they can trade into 47.01. That's the level here where the combo level 3 is from spot gamma. That's really hard to say. But what we know for sure, this volume spikes of that size, 2,436 contracts traded within 1 second. I think it was 1 second. Yes, 1 second. This is of significance. This is important. This is really important, Levi. We should want to know where the exhaustions are. Either we are long, then we should end maybe exiting this position or tighten our stops. Depends on what the strategy is. But if you see that, we are not going long, but waiting until we get some other signs. Or if you are aggressive, you can take a short trade here of the 47.06. But this is all long here, guys. This is all long. I tell you, that's all long. Okay, I would suggest let's do another 10 minutes, and we need a little bit more time today. I hope you can stay with me today. Yes, Myron, give me some time. Give me some time. No, yes, I will explain everything I have and I know, and you will see how it works. But give me some time to explain that. We will talk about in the next. I will suggest to make a break of 5 minutes, just to relax a little bit. But I will show you then really what is working, and you will see that these are really important signals to get you alerted, to tighten your stops. But when you understand the whole system, you will simply trade. You will simply trade. Give me a little bit more time. I will explain it to you, and then we can discuss the whole picture of trading. And hopefully, maybe we will need a little bit more time tomorrow. We will need a little bit of time tomorrow, but then we hopefully will start to trade, to analyze the market based on that, what I've tried to tell you this week. And as well on Thursday, we will hopefully then be very focused on trading and what we see here in the market based on that. Okay, let's do a 5-minute break, guys. Let's do a 5-minute break, and then let's continue with the options. Hello and welcome back. Can you hear me? Can you hear me? Hello, 1 2 1 2. Okay, great. I would like to start and end. No, I would like to end this day with a very, very brief introduction to options. Very, very brief. I'm not an options expert, so we have other guys here on board. Maybe they are quite experienced in big, not big, which are who are great experts. Excuse me, it's late here. Experts on options, but my logic. I will show you at the end, and you will understand the logic what I want to achieve and what I'm trying to tell you latest tomorrow. And I would like to go through the options, just a very, very brief overview, very, very brief overview. And please don't challenge me on options, but you will see why they are important in our strategy, in our trading approach. So we talked about major activities, major indications in the market where we don't need to discuss about, for example, liquidity. We have seen a big player who is selling 2,000 contracts into the market. And finally, all this is good. This is a really small micro world where we are living in, where we as traders only just watching ES, only just watching NQ, only just observing CL, 6E or whatever we are trading. But I will show you the bigger picture. As I told you on yesterday, I have a holistic overview of this market, and I'm step by step trying to lead you towards this result that we need to have a holistic market overview. So, as you all know, options has an impact on the underlying in stock market. So, big options maker makes it possible to hedge funds. Makes it possible for. Sorry, I have to make a cut here in the tape. A big options maker makes it possible for hedge funds, pension funds, portfolio managers, and other market players to trade their options against him. That's the normal way how to trade options. So, and what we just talked about, the option maker provides liquidity. So a big player represents the SP 500 option dealers who make markets and hedge their residual exposure. One most important part we should keep in mind: as liquidity deteriorates, the implied volatility moves higher. As liquidity improves, the implied volatility falls. I will remember you again and stress that we have the liquidity in the book. Keep that in mind. This is an indicator of the possible volatility in the market. When the liquidity in the book is high, the confidence is high, the volatility drops and the volatility is low. When we see an average liquidity in the ES, I'm talking about the ES, maybe lower than or less than 100, then that means the volatility is high and there's more fear in the market. Therefore, what we started yesterday with the order book, you will see the impact and the measurements based on the liquidity and market volume, which has a direct or not an impact, but which are a result of the market volatility. Because fear or greed dominate the market at any time. And as a result of this flow, there is there is a lot of demand of out of the money OTM puts and out of the money OTM calls, as you see here in the picture. Consequently, the dealer's book is mostly short out of the money puts and long out of the money calls. I think so far there shouldn't be any, hopefully everything should be clear so far, but because it's quite straightforward here. And you understand when someone is putting his money into the market and the exposure is high, then in the options we are talking about delta, and this must when he wanted to keep his risk as low as possible or against zero, then he must hedge. He must be this, of course, what he's doing must be delta hedged. So, and that forces the market maker to sell the SP index. SP index, that means SP cash index, that I have to correct that. SP cash index for both the put side and the call side. So, and any positive delta from the options position is offset by the negative delta from the short position, and this results in an overall delta of 0. So the market maker is always, the option market maker, the OEMM, is always interested to keep his risk 0, and that means the delta should be as well 0. The point here, I mean, this is the theory, but as you know, even the market maker and the big institutions are not prone of big market moves. You know, retail traders, how are the apps called? I forgot that. Robinhood and other apps are pushing the market or trying to push the market in a certain direction. And that means as the price moves around, the OMM, the market options market maker, will need to rebalance his, neo brokers and you name it. As the price moves around, the market maker will need to rebalance his delta hedge by trading in the underlying. And these trading activities, of course, is not discretionary. That's not possible. The market maker and who provides liquidity is completely at the mercy of his delta. In order to stay delta hedged, he must trade the S&P as directed by his delta changes. Because, of course, he controls a significant portion of SP order flows. Now, when he is done, let me say everything is positioned in the market. What matters then is how he delta changes, how the delta changes. And as it moves around, the prices moves around, the market maker will need to rebalance his delta hedge by trading in the underlying. The trading activity, as I mentioned, is not discretionary, and so on. The size and the direction of these flows depend on how much dealers' delta wanders around. And that in turn depends on changes in the underlying price, changes in the implied volatility, and changes in time. I see there's a mistake on this side, a typo. I have to change that. But just to give you an idea, when we are talking about all markets and the holistic market overview, what we want to use in our trading to make money is that we depend on these big players. And themselves, they rely or they depend on the changes in the underlying price, changes in implied volatility, and changes in time. So, and now we are coming to Spot Gamma. I don't know, I hope so, and I'm not sure, but some of you might not only trade options, but also are subscriber to at Spot Gamma with Brent. We are measuring these effects of these quantities, underlying prices, volatility, and time. We are measuring them with Gamma, Warner, and Charm. So Spot Gamma is giving every day a report, and he tells us where the gamma is, how the gamma is changing in delta with respect to the underlying price, how the volatility is changing, or Warner is changing in delta with respect to implied volatility, and the Charm is the change in delta with respect to the passage of time. And that's the market maker is sitting around his long out of the money calls area where he is gamma long. And if the index rises, his option delta will increase towards 1 as options gets closer to the money. He will need to sell more of the SPS index in order to counter that. If the index falls, his options delta will decrease towards option 0 because the options get further out of the money. So that means he needs to buy back some of his S&P shorts in order to offset this price movement. In summary, if the dealers are long gamma or long gamma, that means they are buying the dips and selling the rallies, which acts as a kind of stabilizer in the market. If the long gamma exposure is significant, for example, a large open interest, it works as a magnet and pins the index around a certain price range. And when the dealers are long gamma, they provide liquidity by buying the dips and selling the rallies. And that reduces the index volatility. What I'm at this very short and brief overview about options. If you want to know more about options, please go to Cem Karsam, for example, or other great guys in the social media. I like Mr. Perfiliev, who is a great teacher in terms of options, excuse me. And that will give you a little bit more insight how this option market regulates or influences that what we are trading in our markets. That's quite important. Because we are not, you see that this gamma exposures and this gamma levels here on spot gamma. You can have that for Bookmap, you can have them for a NinjaTrader. What I'm doing, I'm receiving the institutional levels who are also based on options. You see they're very close some days with this gamma levels here as well. And what I'm using, I'm using this institutional level just as some guidance through the market all the day. We will talk a little bit later tomorrow about the institutional levels very briefly and to show you what I'm doing here with this institutional levels. But you can subscribe to Spot Gamma in order to get the gamma levels. But what we can do actively, so we are totally we are totally dependent on the market of the gamma. We can't use this actively for our trading. We can't use spot gamma levels very active for our trading. I mean, the call wall might sit at 4700 SPX, that means 4696 in the ES for weeks, and the market is not trading towards a call wall, for example, in this case. Or when we are triggering the volatility level here in the in spot gamma, then don't know where it is today. We can't rely because these are levels which we can't influence. They are there, and we can hope that the market will trade against call wall. You see, they broke the call wall, and the levels I have where indicates a high of 47, 47.02, 47.05 here. Maybe the next one is 47.10. I'm not sure. I didn't report more levels than 47.10. By saying that, the question is, if you want to trade or if you understand, when you understand the options, then it will ease your life. But if you're not actively in the options business, then the spot gamma levels are inactive levels which might be traded today or maybe tomorrow or who knows when. We want to know, and that's the point where I want to go to. We want to know what is really helpful for our trading, and that's gamma, because they are static levels we have in the book, or we have on the chart, gamma, which is the static part of the chart. If you are following spot gamma or if you want to have my institutions level, they are for free. And the other point is the volatility. So you know Gamma, Warner and Charm. Time is a little bit more complicated, and we will see some changes in the underlyings and as well in the trading when we are rushing or we are going towards the option expiration day on 16, 17 every month. That's the important days where all these options expires. The time is let all the deltas coming to zero, and that's the time where maybe the market is a little bit without orientation, because all these big market makers are at a certain moment out of the market. So the market trades, let me say, his own opinions and moods or whatever. That happens around the option expiration day. So we have, again, I repeat it, we have gamma as static levels, and we can control, we can observe options. We can observe volatility. And that's what we want to do today, in the next session, and we'll start tomorrow with the correlations of SPX, SPY, volatility index, VXS. I will show you the UVXY. I will talk a little bit briefly about the ADD and tick, and that will complete our picture as day trader. Maybe it sounds a little bit off, or maybe it's something new to you, but allow me to show you what I'm talking about, and then we'll put these both pictures, the macro view of the market and the micro view of the market, what we discussed, how to put this to a complete discretionary trading picture. So to repeat it, as liquidity deteriorates, the implied volatility moves higher, and as liquidity improves, the implied volatility falls. We are now gamma, we are now in the volatility part. And the great part, guys, ladies and gentlemen, please listen. And the great part of these volatility indexes and the SPYs and the QQQs for those who are trading NQ is that what we have discussed up to now is valid for every single instrument. I think you start to see the connections between where we started yesterday with the auction, with a dome, with a liquidity, and then volume spikes and sweeps. And then you start to see that this picture comes together when we're talking about the SPY. I have the SPY here on my chart. For those of you, I will go a little bit more in detail for every one of you, because that might be something new for everyone, but it doesn't matter. The principles, what we have discussed up to now, are same for every single instrument. They're a little bit different. The liquidity is different. The volume is different. Therefore, I'm insisting to watch the market volume for an instrument. It doesn't matter if you're trading CL or NQ, or the average liquidity and the average liquidity of the instrument. So this is the SPY. Given we are here at the beginning, this is the start of the session 9:30 a.m. Eastern Time, and we have this. It's not correct, but anyway, it doesn't matter. Now we have the market progressed until 10 o'clock in the SPY. What do we see at 470? I know it's late, guys, ladies and gentlemen, it's late, but come on, work with me. The next half an hour, we will go straight forward and we will go more in detail tomorrow, but try to work with me here. Come on.
Liquidity.
Yes.
Liquidity.
Okay, great.
Liquid.
Great. Liquidity.
Okay.
Look here. 12,449 are still sitting on 470. What is the SPY? And the first idea, the very first idea, when you watch SPY, you are saying, okay, there's 470, there's big liquidity there, 12,449, because now you can quantify the number, you see the number in the dome, because you have the dome on your chart, and that's the, yeah, what we have talked about. Now you start to see that 470 might be an interesting point, but the most logical point when you see that, when you realize what we are talking about, is that the price might go towards this or trade towards this 470. And if the price trades towards 470, what does this mean? What does this mean for the yes?
Yeah, it goes with 4,000. Yeah, it goes with 4,700. Yes. Right. Buy is a tenth of the
yes.
yes. Huh?
Now for those, let's go step by step, because I want to have every one of you on board. The SPY, the Standard & Poor's Depository Receipt, or SPDR, 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 is a type of exchange-traded fund that began that began trading on the American Stock Exchange in 1993, when State Street Global Advisors Investment Management Group first issued shares of the SPDR 500 Trust, SPY. Sometimes called SPDRs. SPY is an ETF based on the SP 500 index, and each share represents an ownership interest in the 500 stocks in the SP 500. The value of each unit in any SPDR exchange-traded fund at any given time reflects the movement of the underlying index. Trading under the symbol SPY, the SPDR 500 Trust, for example, is designed to trade at approximately 1/10 of the level of the SP 500. All the links, if you want to know more, are in the documentation. See Investopedia if you want to dive more into this instrument and the following instruments. This is not my this is not my text. I'm just copied that from Investopedia, and it's a copyright on Investopedia here in this documentation. Excuse me, I saw. Oh, what happened now? I saw a mistake here. I just have to. Okay. It's very clear. The SPY is the SPDR is the ETF, and the SPDR, the underlying of SPY, is the SP 500. And when we see the same structure in the SPY, look here what happens here. How genius this is. Along the SPDR, we will talk about other instruments which totally completes our picture of the market. Then we saw this 470 at the beginning of the session. And then what we see here is here. What happens in 471? Yes, Alexander. Liquidity. Liquidity came up, or was added at 12 or 1, what is this? 114, 115, it doesn't matter. But you see with one blink of your eye what the market is telling us. We have had some volume spikes which are exhaustions and need to trade back. They need time to find new buyers in this case. We saw a volume spike here in the SPY, and therefore that's the genius of TradeFinder, because you can use it on ETF, on stocks and so on as well, and it gives you meaningful information, important information about this market. And then you see the liquidity comes up at 471. So excuse me, go ahead. Was there a question? I'm not sure. Yes.
One question, Walter.
Chris, I look at more, not only on the SPY. Just give me a few minutes to explain everything. Tomorrow we will discuss about the whole process and what we are discussing here. It's not only the SPY. There are some more valuable information what really happens. So excuse me.
This is Euless again.
Euless, okay.
This is Euless again. So there's some liquidity also added around the 4701 area.
After the fact.
Like after the fact. If you go down, how do you interpret that?
47.
I'm sorry.
I'm actually talking about the ES.
Okay.
So
Okay. Just a moment. I have to switch back here. You mean 4701 here?
Right.
Yes,
Right.
it is added, but at the moment the price could go towards 4710 and 12 and as well 4701. There's no how I'm judging, how I'm seeing this it's an information. It's an maybe alert that the price can go up into 4710 where this institution level sits and then go back to 4701. At the moment, Euless, we don't know how the market will behave at this stage of the market. We recognize and we keep in mind 01 is a level and 10 is a level. Let me just draw the price alert. So these are the levels we are just working with. Based on the information here on the SPY, we have we're on the traction point at 471, and based on the yes, we have an attraction point at 4710 and 12 here, as well as 4701. It's really hard, Euless, to say whether the market is going straight away now down to the 01 or it's going back, finding new buyers, and they are trading at the end of the session, which is in 2 hours, 2 hours and 20 minutes. Is trading then towards 4710 or maybe even 12. I'm saying I'm judging that as, or I see that as simply information of the market, which wants to bracket the price around 01 and 10. This is the next level here, and I'm suggesting to go step by step to the order. When you are long, given you are long here, because everything is screaming long at the moment here, giving you a long, simply protect your position here. And that's all what we can do. We don't know at the moment where the price is going to trading into 10 or even 01. That's my interpretation of the market right now. Does SPY or ES give better signals for day trading VS, or is it perhaps best to use both? No. Give me some time to explain everything, and then we can discuss the whole concept, because it's genius. I tell you that. I strongly believe that. I wouldn't say that. Otherwise say that. That's the picture right now. We have the attraction point 471. Although keep in mind, don't fall in love with all liquidity levels. They can be cancelled immediately. But as the price, as the time goes by and we are trading that, we see very nice signals on the SPY here, and we see a kind of attraction point at 471, which means is 4710 here. Not sure if they are going to hit that right now, but anyway, the market is maybe in a break point at the moment. We have two extremes here, 10 and 01. That's the point. So I'm not sure. I wouldn't trade that because I don't see anything which is tradable at the moment at this stage of the market. There's nothing I see. Maybe if I'm risky, if I'm aggressive, I would like to go long. Yes, Argo, it's a balanced market. It's nothing special at the moment we have here. Maybe if you are really an aggressive trader, you can take the sweep and go long off the sweep here of 5 into 7 and 7.5 and fighting for 2 points here. That's a theoretical discussion right now. But just to give you an idea, first of all, when we trade ES, we are watching the SPY. Second, I didn't add that to the documentation. If you are trading if you are trading Nasdaq, if you are trading NQ, excuse me, then you have to watch the QQQ. You must do that. I'm saying really consciously, you must do that, because the QQQ is the SPY for the NQ. And please go into the Investopedia and read about the QQQ. I would suggest to go with a QQQ and NQ as well. But that's not the only one we are watching. Sometimes we will discuss some pictures I have prepared based on here on this my trading style. We have sometimes the SPY is building in divergence to the S&P. Sometimes the SPY is building in divergence to S&P. We will see that maybe not today but tomorrow. Okay, the SPY. Keep in mind the SPY, the spider, is the ETF. Excuse me. I've got a bookmap error here. Okay. The spider is the ETF, and it's trading the underlying index. That's the S&P 500. Okay, I think that's easy to understand. If you have questions, please go ahead and
Walter, between SPY and ES, is SPY, is SPY precedes? I mean, we saw the liquidity on SPY, and we also saw the liquidity on ES. Can we assume SPY precedes?
No.
ES?
No.
Is it not the right
no.
assumption?
No. Based on that, what I've learned in this market is we don't have any advantages. We don't clear advantages that one index like the SPY or one ETF like the SPY is preceding ES. No, that's not the case. But what we can say is that we can find sorry? No. That we can find, just give me a second, excuse me, as well, cut here. That we can find divergences, for example, or we can find anomalies where the ES is, where the SPY is trading lower than the ES. We will see that, and we will discuss that in maybe today or tomorrow. I don't know how long time you have here, but we see it's not that SPY is preceding S&P, and so we can say, okay, the SPY is rising, so the S&P must rise again as well. No, they are in sync, totally in sync, but we can see as I mentioned, for example, divergences. We can see how the SPY behaves based on the volatility. Give me a few minutes to explain everything, then you will see the whole picture. Coming to the wicks. As I mentioned, we have we have the, come on. We have the gamma levels here, which are static. And we have the institution level to be based on gamma, on options levels, whatever it's behind. And now we have this, the SPY. The SPY here. I don't know what this is here. We have the SPY, and then we can say, okay, the market is most probably trading higher. Good. Now, besides gamma, we have the volatility index. We have the volatility futures. We have the VXX. We have the UVXY. VXX is the ETF of the volatility index, and UVXI, I think, is the stock. Give me a little bit more time. Give me a time for a few minutes to explain everything, and then we can discuss. So the VIX measures the short-term 30-day market volatility of the option prices of the SP 500 index, taken from a range of both call and put options. VIX levels above 30 generally tend to indicate high volatility. Those below 20 tend to indicate low volatility. VIX is just the price of every SPY option within 30 days of expiration. The VIX is interpreted as an indicator of the level of investor confidence or fear in the market, and therefore the level of investment risk, but it is commonly known as the uncertainty index. Okay, what we want to see is the VIX. This is the next friend of our trading chart we have to have a look at. I don't have a chart here in Bookmap of the VIX future, because it's trading extremely slowly. That's what I've got from the XFeed. So I'm not really happy with that, but we have alternatives. This is the VXX and this is the UVX. The VXX, excuse me. This is the VXX and the UVXY. First of all, the VXX. This is a volatility ETF. So we have the SPY, and now we are coming to the volatility in the market, because that's the only point we can control the market when we look at the SPY and when we look at the volatility. The volatility ETF will typically move in the opposite direction to major stock market indexes, such as the SP 500 index of the Dow Jones Industrial Average. For example, when the S&P 500 is rising, volatility ETFs and ETNs like the iPath, week short-term future VXX, what is this called, will typically decline. On the other hand, when the SP 500 is falling, volatility ETFs and ETNs will usually rise. Now let's have a look at the VXX in Bookmap. I recommend to everyone to have the VXX in the Bookmap. Yes, as well in the Bookmap, because as well here, it's a little bit harder to read. Really, it is really a little bit harder to read in terms of liquidity. But what we can see is a clear decline of the VXX. Clear decline at the beginning. And as well, this market is not preceding the S&P market or the SPY, but it's in sync with all these markets. So the VXX is an inverse market, which indicates, okay, the fear is very low today. Therefore, we can say at the beginning, we should go long in the S&P if we are trading S&P, for example. Then we saw a quite nice, what is this? And maybe a volume spike here, not sure about that. And then it went sideways, and then it goes against this liquidity. When the VXS traded here, as mentioned, the liquidity came up at 20 here. And we can then assume that he is going to trade towards this liquidity, which means, because it's an inverted market, if VXX declines, the market will rise. The S&P market will rise. The same functions applies to the VXX here. You see what happens right now. We have a little bit more upside from the low of the market. From the low of the market here. So that means it is most likely that the market, the S&P, is maybe coming to a high of the day here. Not sure, but it can happen. It can happen. So we're very cautious with the longs here. If they can't break to this level. But let me see just a moment here. Yeah. So the fear indexes, that means the volatility is rising as well. The S&P is rising. We will see what happens next and how to use this information for our understanding of the SP market here, of the S&P mini market. You see it's rising, and then as well as S&P is rising. That's quite unusual. I would say that's a divergence. That's a divergence. The next one is the UVXY. UVXY, and the UVXY is also called a stock, the volatility stock market, or ETF, which is constructed to track the performance of an underlying index, such as the SP 500. The leveraged exchange traded funds ETFs with the highest 3 months level average daily volume are SQQ, TQQ, and UVXY. For those of you who are trying to trade or who are trading in NASDAQ, QQQ, SQQ, and TQQ should be mandatory to watch. I have not them on the chart here yet, and I haven't tested them, so I can't say anything or contribute anything meaningful to this ETFs here. These ETFs provide inverse leverage exposure to the NASDAQ 100 index, leverage exposure to the NASDAQ 100, and leverage exposure to the SP 500. That's important for us here. Exposure to the S&P 500 VIX short-term future index respectively. Let's have a look at a UVXY. From my point of view, that's the far better picture, and I like it the most, because I have quite good reliable signals. Additionally, to the SPY, to the SPX market, for the S&P A mini future, and as well for the VIX, because it is fast, it is highly traded. There's enough liquidity and volume in the UVXY, to say, okay, the market, the only point we have to do here is we must go long. There's no how to say, a discussion what to do here. When the market went up, when the market drops, I will show you another chart I'm using, and I'm using only two charts, one Bookmap and one tick chart. When the market drops down, we have to buy ES. We have to buy ES. I'm sure this have been this sweeps we have seen in the book, but the market was strong bullish. Market was extreme strong bullish, and we have the same. Today it's a little bit more. It's a little bit more it's not so clear. On some days it's much clearer than on other days. But anyway, go back here and you see liquidity resting here on 1416, 1455, and 1450. So when we are following our liquidity logic, when we are following that liquidity logic, then at that point we have the information that the market will trade into this 1460 or 1465. In the meantime, we saw liquidity on 1515 here. That means the market went a little bit up here and then started again to drop down. That means we have a very bullish ES in this case.
Can you keep the side by side?
Yes, of course. I will show you a better chart because it's a little bit much harder to watch that. So what's interesting here is the volatility starts to rise at 7 p.m. my time. That means, what is this? This is 1 p.m. Yes, 1 p.m. Eastern time. Started to rise here. That's quite unusual. That's really a little bit off. I would be very cautious with further long positions here. Although we have a supportive liquidity at 47.01, and now this liquidity is cancelled, and liquidity is added at 10 and 13, 12, 13 here in this area. But anyway, I'm very cautious with long positions here because I see the volatility is rising. And as well, ES is rising. That's totally unusual. That's totally unusual. Okay. And what I have added to my chart, and that was maybe this is really totally new to you. I would like to see the high yield corporate bond ETF. I was told that by my friends that the high yield corporate bond ETF is interesting to watch. It's an extreme slow ETF. Nothing proceeding, nothing going forward or foreshadowing anything. But it is an extreme, I value that, this HYG high yield corporate bond, because the bond, the HYG bond ETF seeks to track the investment results of an index composed of US dollar denominated high yield corporate bonds. One of the most widely used high yield bond. Exposure to a broad range of US high yield corporates bond. It shows. So it's extreme slow, and it's not proceeding as well as others. I'm not proceeding anything or anything here in the market, but we have the same let me just stretch that. I see I have to adjust it a little bit better. We have the same principles like we discussed yesterday and today. We have the same principles. We have support on the liquidity support here. We have synthetic icebergs. You see how big this high yield bond is. We have liquidity on this side, which acts as a resistance and acts as a resistance as well here. The interesting point with a high yield bond is that it starts to rise. It started to rise at 16 from what is this, 10:30 a.m. Eastern time, 10:30 Eastern time. And now what's totally interesting to watch, it started to drop at 12:30 around. started to drop. This is not an inverse indicator. This is not an inverse indicator. It goes in sync with the SP, with the other indices. Not totally in sync, but in sync. When it rises, you will see ES is rising or SPX is rising. When it falls, when it comes back, when it's traded back, then you will see by the time that the indices or SPX is falling as well. It's coming back as well. Totally interesting, maybe totally new to you, but it's really worth watching it and seeing what the market is doing here with the HYG as well. So, what can we control? What is under our control as day traders or maybe midterm traders? It is what we see on the book, in the order book. It is what we see on the chart. Here, live trading, liquidity, support, resistance, sweeps, maybe icebergs, adding, cancelling liquidity at different levels, fighting with the market. That's what we see on the book. That's real-time indicators. Nothing to guess or to argue about, because if liquidity is there, then liquidity is there. There's nothing to say about liquidity. But what we just should add to our arsenal of weapons, what we should have in our bag when we are trading, is that we should understand the underlying markets. We should understand the influence of the options, of the option market makers. And we have the spot gamma or institution levels on our chart, which gives us a kind of direction. And on the other side, what we have under control is not only gamma, because it's static. The only difference is if you are trading options, then it's not static. But for normal traders, day traders, gamma is static. But what we can vividly watch and look is the volatility. That means we have gamma, we have Warner, which we have volatility, and based on all these options, we have the VIX, or we have the SPY, we have the VIX, we have the VXX, we have the UVXY, and we have the high yield bond, which indicates which help us to determine the direction of the market. It's an additional important high yield influence of the market. And you will see most of the time, if you want to follow this approach, because it costs you nothing, everything is there. You don't need anything to follow this trading approach. It's everything there. So we have in this case, I would say, we have a holistic market view. That's what I'm calling a holistic market view, because we have everything, let me say, under our, I don't know whether control is the right expression. I'm looking for another word. We have everything in our, I'm missing the right word right now. So we have everything under control. We can see that, we see the market, we see how the market behaves, we see the volatility, which is the Warner, we have the gamma on our chart, and we see as well as additional, we can add the high yield bond, which gives us a wonderful overview over the whole market. So therefore, we will stay with this market view. I will show you how you can apply this market view to your charts and how you can simply observe what the market is doing here. A comprehensive holistic market overview gives the smart trader an edge. It is an edge, and it's a real-time edge. It's a real-time edge. You don't need to spend money on really intensive additional indicators. Not necessarily not, but you can, of course. That's up to you. Trader will get the final confidence along with the discussed market signals about market direction, market divergences, and other market anomalies. There are a lot of them, or could be a lot of them. A complete market snapshot will allow to keep execute. A complete market snapshot will allow you to keep, execute, or to stay away from investments. That means, Jay, are you around? Jay is not around today. The most hardest point in our trading, is to be patient, guys. It's really, we need to be patient. If we are not patient, if we can't wait, and if we think we need whatever signal we want to have, a sweep or a stop run or volume spike or iceberg or whatever, they can give us an edge in trading. But we should understand what the market is doing as a comprehensive or holistic market view. And when we see the market is going long, then we should join the market in the long in the long position, or to buy the market. We should buy the market. We should buy the market. And we see there are divergences. We should be cautious. And if we are aggressive, we should take the opposite trade. That's the art of trading. We are warriors, and we as a warrior must understand how our opponent, how this market is going to trade, and we should then jump on this market. Let's have a look then here on this chart, and let's answer. I hope you are everyone is on board here. Let's answer the question of yesterday. Excuse me. Let's answer the question which came up yesterday. The question was, let me find a point where we started to discuss. I think it was here. That was the point. It was 5:34 my time, and we have had a discussion yesterday based on this. The question was raised. I don't know who, but it doesn't matter. Can we predict this move? Do we know what will happen next in the next 10 minutes? The answer is very clear. No, we can't do that. But can we predict the possible direction of the market when we are here? We mentioned, yes, there was an, what was it, iceberg or volume spike or stop run traded here into this area. Then we saw an liquidity here, and we saw the liquidity here. So let's just move this around or move this away here. And that was the point here. And I mentioned tonight, or I woke up this night, and the answer was very clear to me what to trade here. I mean, it's hindsight, but anyway, it doesn't matter. Have a look on my chart here. That was roughly this area. You see my chart? Hopefully you see my chart here. This is the area we have had this discussion yesterday. Okay? 17 or 5:30 means 11:30 Eastern time. Okay? That was the stop run here, and the market went away, and then the market broke down very hard. The question came up, can we predict these moves? No, we can't. But we saw on Bookmap liquidity here, and liquidity there. So for those of you, just repeat myself, this is the SPY. This is the WIX, 1 minute WIX here. Then I have the VXX expressed in ticks. The UVXY expressed in ticks, 300 ticks, and the HYG expressed in seconds because it's extremely slow. That's the only reason why I'm using seconds here. Now, let me annotate this market. Do you see what happens in the underlyings of this market here? Can you see that? Algorithm, holistic view.
Slow down.
Ah, interesting. HYG dropping. Tom, great. Great stuff. Excuse me, I missed your answer. I don't know who it was. Okay, that's the SPY. Yes, Karen, great, fantastic. That's the SPY here. Okay, that's the SPY. Myron, yes. Now I'm just putting the line here. I can stay in draw mode, yes. Give me a second. Okay, I have to switch that off. Do you see what happens?
I think, Walter, if you extend the top rectangle to the down, that'll be much easier.
I can't draw over. Okay, can't do that.
The one you already did. No, the one you already did, not the new one. Yeah, you can hold that one and then
how can I do that?
You can click on it. You can click on it, please.
Just
click.
moment.
No, just click on the. Yeah.
But I can't extend it over the. These are separate charts, so I don't believe that. But let's do something else here. I think it was 35, 34. That was the time. So roughly when we are looking, let me have a look here on the book map. Where's book map? This is, what is this? 37, 38, 37. Here. Roughly, that's simply roughly what we saw, what we have discussed this question whether we can predict this move or not. You see what, that's not quite precise what I did here. Ah, come on. I must be more precise here with the drawings. But where I want to draw your attention is, okay, so that's the time, 35, here, roughly here. What do you see? It starts to rise at 45 my time, so that means 11:35. But you see very clearly what happens in the underlyings. When the market starts to drop here, it indicates something is wrong. You must be alerted. Just wait a moment with the answers, Myron, Ed. Yes, as was making, but yes. As ES was making higher highs, but VXS do not make lower lows, but double bottom. It was not yearly. It wasn't even. My chartings, my lines are not really correct here, so apologize for that. Just make it a little bit more precise, just to give you an idea. So the ES is trading, and the volatility is falling, coming down here. That means it might be a very pleasant up move. But suddenly, somewhere here around 11:15, whatever time, they started to rise silently, very silently. They started to rise. So that was the extreme fast move here. You know, that wasn't a prediction. Let me do that this way here. That wasn't a prediction that we will see a 10, 20 point or 30 point move here. We can't say that. It's not predictable, and you understand it. I'm sure you understand it totally, that this is not a prediction system. But it is a wonderful real-time indication what the underlying market, in this case S&P and the other side NQ as well, will do. It's wonderful, guys. Believe me, it's wonderful. So we are here. And what do we see? We see rising VXX, UVX, and the most interesting part, I think Ed mentioned that here. They are showing bearish divergence, Ed. Excellent. HYG showed at that time bearish divergence. And that point, when you want to understand your trading and what happens, you should, and therefore I will stress that tomorrow and the day after, and when we meet in the trading room, you will understand why I'm taking a long or short position, because bearish or bullish divergences are so dominant in this market now and then, not every day, but now and then, that I'm simply taking the trade. I'm taking the risk and hoping that the market will trade on. It will go in my direction for some points. Most likely it will go against me, testing the double top here, and then when something happens, what it did yesterday, give me 10 points back here. You see the divergences in H, Ed mentioned that in the chat, HYG. You see the divergences. It started to lift off in the volatility stocks, ETFs, and even the VIX. It's slower. It goes a little bit slower. Therefore, I like the VXX and the UVXY as a complementary charts, because they are trading so high with so high volume. They are trading really really hard on that, and that makes this simple understanding that we can use Bookmap for finer to tune our entries, and we can use gamma or institution levels to understand where the levels might be. We can use the Warner, the volatility, actively in our trading to control our underlying market. Not to control it. I don't find a better word, maybe, not to control, but to see what the underlying market will do. To see what the underlying market will do. And then with a fine-tuning, first of all, with an overview of the market and what the market is doing, and with a fine-tuning, we will try to find the sweet spots where we will get the best risk-reward ratio. Alexander, this is kinetic. Or, in other words, I have the X feed as well here. This is the X feed. Okay, guys, but that was the answer. How do I know if I want? How do I know whether to short or go short or take a position here at this point? I know that because I'm watching the volatility index, the Warners, the family of Warners here, and I'm watching the HYG, and I'm watching the SPY. So I know that beside the stop run, which I have discussed, or we have discussed with Raimo, that was the most important argument to short the market, because it was evident. But let's go back now to what I mentioned before. Let's go back to what I mentioned before here in the volatility indexes. You see, we are just, let me see the ES. I bet it's down. Yeah. Institution level. You won't get these levels, never ever, for no money on this world to watch them. It's so important to have them. I know it's unbelievable for the most of you, it's unbelievable, but it is as it is. Now, what happens in the Warners? At 7:06, that means 1:06 Eastern time, they started to rise, and got their point at 1:48. So when I see this, I'm very cautious with long positions. It is hard to say they will immediately drop down. But we have a kind of really weird and strange signals in the market. First of all, that was a great, divergence happening. That was a great drop down. You see, you have to go long here. The question is, where do you join the market? We have to really fine tune, and that's what I'm saying. We have to fine tune when we are here. We have to fine tune our entries. So far we know there was nothing around here. There was nothing around here. We have support. We have had support. We have the divergence here as well. Maybe you can trade even the breakout here of 68 88, because the market is dropping down very nicely here. The WIX is down, the UV, the VXX, UV is down. Although it's a little bit, it started to become a little bit weird here, a little bit uncomfortable, because you see that HY started to drop. They made a leg up here. That means volatility was higher, dropped again, gave some hope, and it's rising higher. This is not the common behavior of this market when you watch them. And if you do so, you will learn. You will learn the characteristics of these markets. You will be alerted. Okay, the market is going down. That means S&P is going up, and I bet the NQ is as well going up, or went up here at that point. But as I mentioned, it is not important at the beginning whether I see a stop run. That's nice, but I want to see this. I want to see the volatility dropping, and then I'm joining the market. I want to see volatility dropping. I want to see HRYG support my idea, although in this case was really, really reluctant to follow here. In this case, the second leg was most prominent, but they are really reluctant with it in the high yield bonds here. And but the first impression was right. When the market started, WIX started to fall, come down. So our task is to go long. Question now where we can discuss is where we do enter the market. Now here on the chart we have an exhaustion, we have a strong selling buying double bottom here, and then it lifts off here. We have green, and together with we have green. That means they are lifting the offer here. They are lifting the offer. We see the volatility dropping, and the market lifts off through all liquidity. Oh, Raymer, you should tell me that. Maybe you can send me an email. What are you using for divergences in NinjaTrader? Let me know that. Yes, okay. I would like to finish the day for today and leave you alone with your thoughts, with your impressions of these 2 days. And I will start to discuss the rest of the presentation and how to fine-tune the system that will make you a profitable trader. I will talk to you tomorrow about this, the possibilities we have as traders in this market, and that is works for ES, that works for NQ. For stock markets as well, we don't have the volatilities, but as well we should have a look at them. And we will discuss that. I think you are extremely quiet right now in the room. I mean, you have been all the time extremely quiet. And let me speak and let me preach what I wanted to say. I would like to know your thoughts, and every discussion is welcome. So we will discuss tomorrow this stuff. I don't know why. Yes, you see as well here on the other side, on the SPY and the WIX, if they are immediately at the beginning start to rise, then you have to sell. So these are the correlations. What we are watching and what we should know is we need a SPY. I recommend the VIX, VXX, UVXY. Then we have the cash market as well. Volatility indices are inverse markets, and we are using, or I'm using, the HYG for the S&P. So, and that build and gives me a comprehensive and holistic overview over the market. I can say to nearly every point of the day. It's a little bit too strong what I'm saying, but I can tell you maybe most time of the day what a market will do. The question is not how to enter, how to manage your position. What is your risk-reward ratio? What is your risk profile, for example? That depends on every one of you. You must answer that, and then go. Okay, thank you, Raimo. Okay, guys, any questions so far? We are almost done. We are almost done with the theory. We will need a little bit more tomorrow, but then let's do a practical session. Let's see, where's the ES right now trading? I don't know. Oh.
Voltaire, can you about chart?
It's a black chart for Ninja.
It's a black chart for Ninja Trader. If I do on the interactive or on the FinFish, because I'm not using.
You can use
Ninja
that, Levi. You can use that with. You're welcome, Karen. So you can use any chart system you have. It depends on the data feed. So I'm using Kinetic here as well. I'm using that on the Bookmap as well. I'm using Kinetic and I'm paying for the data feed of, I think it's Nicey, not sure. You can use it with Sierra chart. You can use it with Thinkorswim, whatever chart you have. It depends simply on the data feed.
I have Interactive level 3.
Interactive brokers. I didn't understand. Interactive brokers.
Yes.
No, you can't. I'm not sure. I don't know. I have, by the way, my broker is as well Interactive Brokers. But I'm not sure if this is working with Interactive Brokers because I'm using, I have the Ninja Trader. You can, by the way, that works with Ninja Trader, the free version. Ninja Trader has several versions. If you are not trading through Ninja Trader, then you can simply download Ninja Trader version 8 and install it and run it. It works wonderful. So the only point is you need the data feed for the NYSE and for the NASDAQ, for the NYSE and CBOE. Excuse me, it's CBOE, not NYSE. It's CBOE. It is CBOE, and if you have this stuff with CBOE, the data feed, you can add it to the free version of Ninja Trader. Oh, TradingView.com has auto symbols too, but have to pay for real-time data. Okay, guys. Myron, which underline it is QQQ? It is as well as I told. Go into the documentation. It's what is this? FQQ and TQQ, I think. Please, Myron, go to the documentation and see there's an opposite of the SPY, which is QQQ, and there's an opposite of VXX and UVXY. I haven't had a chance to look at it, but it doesn't matter. It's all there. Everything is there. for everyone who wants the data, it's the CBO data, CBOE data. And if you want, I strongly recommend, or otherwise, if you don't want to do this, go to the XFeed, subscribe to the XFeed, you will get HYG, you will get QQQ, you will get VXX, the SPY, and the VIX future. I don't have them on the chart because they are extremely slow. You have to go to bar chart or stock tradingview.com to find symbols for VIX future as well. I mean, or barchart.com, you will find the VIX futures, the label or symbol, and you can add them on your bookmap chart, which is quite interesting because if you have several screens, you can link the charts with the symbol here, synchronized charts, and then you will see immediately what happens. So my chart is showing on the UVXI at exactly 7 p.m. That means 1 p.m. Eastern time. And where is the EX? That means, so it's rising, started to rise here, and we have a nice institutional level here. You see how perfect it works, far better than spot gamma levels. And then it's simply amazing, I know. And it went to the next institution level here. It's unbelievable, guys. I know it's unbelievable. You won't believe that, but it works really. So the XV, where do I get it? Bookmap back? Yes. No. When you are subscribed to Bookmap, when you are subscribed to Bookmap, you need to go to your Bookmap portal. You need to your Bookmap portal, and in your Bookmap portal you can subscribe to the XFeed and the different data feeds they're offering. Historical data, the XFeed. I can't even remember what it is. So great, guys. It was an exciting day. It was a demanding day. It was a challenging day for all of you. I know that. And I think that's the best way to stop it here. Digest this information until tomorrow. Digest it. Think about that. Let's start tomorrow discussing this concept. I will show you some other points which you can use in the strategy, the micro view. But together with the macro view of the market and the micro view, you will start to be profitable. Believe me. I have another motivation for you tomorrow. And okay, stay tuned, and we talk tomorrow, okay?